All right, everything looking good. Should be live. Let me know in the chat that we're coming through loud and clear. But in the meantime, let's go ahead and get this party started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on April 10th, 2022. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Hey, what's going on, Yoda? Thank you, my man. Asodos, good to see you, brother. Loud and clear. Thank you, sir. Peter Gerd, what's up, bro? Hopefully everyone is doing well. Appreciate y'all chiming in. Let's go ahead and jump right in. Got plenty to talk about. So we're going to be taking a look at the stock market indexes, a couple of our main big tech stocks, the big boys. We'll take a look at the TNX, the DXY, and then we're going to do a little bit of a deep dive into some uranium stocks, a couple of the ones that I'm invested in or trading in and out of. And, obviously there are lots of other ones out there. These are just a few of the ones that I partake in. And then, of course, we will take a look at cryptos as well. Obviously, we saw a little bit more of a resolution on what we already expected, not only in the stock market, but in cryptos as well, with our close on Friday. And then, of course, last couple hours of the day, some bearishness coming in. And then over the weekend, we saw basically sideways action on crypto, an attempt to push up to the 4-hour 200 EMA and SMA, and then a strong, powerful rejection in the last couple hours as futures open. And we are revisiting the micro lows, continuing the downtrend and very close to losing the 200 simple moving average slope, confirming once again that on a 4-hour time frame we are back inside a bear market. And then, of course, we have already confirmed that basically on the daily, on the spot markets, but we're very close to confirming it again on futures as well. The only reason it hasn't yet is because the 200 simple is lagging. So that being said, let's take a look. Greetings to you as well, my friend. Imad, good to see you. Thanks for chiming in. Appreciate when everybody says hi in the chat. It always helps out. YouTube always appreciates the interactions as well. So, but yeah, let's take a look at what we've got going on here. So we'll just start real quick with the TNX. Obviously, we see this thing continuing to surge to the upside. Closed at 2.71. Also, there was an interesting disclosure. Obviously, we heard from some of the Federal Reserve, the chair, a couple of presidents, and some other members as well as of late. And what they're talking about now is we obviously saw their dot plot. We went into that in detail for where they expected rates to be, which was essentially just under 2% by the end of the year, which was roughly 7 rate hikes. So that being said, there's now talk of them wanting the Fed funds rate to be over 3% by the end of the year. And we know what that means. If the Fed funds rate goes to 3% by the end of the year, we will have a technical breakout because we will expect the 2-10 or any of the other yields in the long or short end of the curve to be much higher, or at least that high. So that would basically be a technical breakout of a 40-year downtrend. So that is an interesting development, and once again, a very, very bearish headwind that is, people say everything's priced into the market's forward-looking. The truth is there's a lot of really bearish things that I guarantee you 100% are not priced in, because there's still a lot of people saying it's impossible for the Fed to raise rates that high, something in the market will break, and then the Fed will have to reverse course because that's what they did every other time. And we need to remember, once again, that that's what they did every other time in the last 40 years while we had no inflation or low inflation. But things are different this time, and I'm not just saying that. So we have seen basically at this point in time a technical breakout of key levels in multiple different fashions. We close now above the 786, and we're very close to a completion of this move up here, the measure move basically taking us to the 886. But the most important thing that I think we all need to be paying attention to is we have a very clear technical breakout of that 40-year downtrend. So we were talking about if we closed the weekly outside of that range, what it was going to look like. This chart's a little crazy, I know, but if we just focus on this green line here, this channel, going from basically 1986 or 80, whatever you want to, wherever you want to technically start it at. I guess technically at the bottom. 1986 till present. We have basically 40 years of touches on the bottom and top of the channel. Now we see a couple times at the bottom we kind of poked out a little bit. We see, here in 2018 we poked out a little bit of the top, but now I'm going to turn off the drawing tool real quick, and we can see that we have very, very clearly closed an extremely powerful candle outside of it. Not to mention, we are literally going straight up at this point in time. I mean, it would be damn near impossible for us to be going up any faster. So is this going to be a blow off top sometime in the future and we're going to pull back? Sure, probably. How high does it go before then? Well, we know that markets can stay irrational, longer than people can stay liquid. So all the people that have been trying to call for the bottom of the bond market, saying this is it, I'm buying the dip, now's the best time to buy bonds, buy when there's blood in the street, when there's fear. Well, they've been saying that for how long? And now they've been getting absolutely wrecked. Not to mention the pressure this is causing on the housing market as well. There is a lot of people that refinance with like a 5-year loan, and then the interest rate resets after 5 years or sometimes 7 years. I mean, there's various different time frames. So a lot of people are locked into a payment, and then suddenly your payment might go up by $300, $400, $500, $700. That's going to be, even if they can afford it and they're not going to lose their house or foreclose or have to sell their house or anything, that's still money that they're not able to spend on other goods or services. Not to mention food prices going through the roof, energy prices going through the roof. What does that mean? Well, it means that as long as those prices are going up, once again, that is less disposable income that people will be able to spend on, other items, discretionary goods, whatever, into the economy. So the more expensive these necessities are, the less disposable income people are going to have. And this does not just apply to, poor people that spend all their money every single week or month or year, or, lower middle class. It applies to everyone, because as people see this tightening, many people that are up higher on the food chain, are business owners or investors or, whatever, typically make their money through, the labor or work of other people. So they're going to see these same things happening, and then they tighten up their belts as well. So we see the spending basically getting cut by the consumer across the board. Not to mention, people are less likely to make like capital investments and whatnot. I mean, the only people that are moronic enough to start doing infrastructure and spending massive amounts of money on, goods while they're at record all-time highs is the government. The government's the only one that's stupid enough to do that, because they don't have to worry about a profit. They don't have to worry about just pissing away everyone else's money, because they didn't work for it. They just take it and then they spend it on dumb stuff. So if you're a capital allocator, if you're a business owner, a small business owner, investor, whatever, the last thing you want to see a business you're invested in or that you're owning investing in goods or services while they're at record highs. That's a horrible way to allocate capital. Not to mention, if you're in a situation where you know that the future is uncertain and there is definitely some possibilities that we could see pullbacks, crashes, recessions, depressions, anything like that, that puts you in a situation where you're going to just wait out the storm. And that is exactly what the oil market is doing right now, and much of like the energy market. They're not going to be reinvesting capital in uncertain times when they've been, not profitable for a handful out of the last, 7 years basically. And then all of a sudden they're finally making some money. They want to return that money to the shareholders. They don't want to start building, refineries or, opening up new mines or, working on drilling permits, etc. That essentially they don't know how long this little boom is going to last for, and it could very quickly become a bust. And a lot of them got burned last time, because that's exactly what they did going into 2014. Spent a bunch of money on, new stuff, new factories, new equipment, new whatever, and then all of a sudden everything crashes and oil prices drop substantially, and then all of a sudden it's not profitable to do these things anymore. So in my opinion, we're in a very uncertain time. And then on top of that, people are trying to call the bottom of the bond market the top of the yield market. And the truth is, the Fed is now saying 3% on the Fed funds rate, over 3% by the end of this year. So think about what that really means. I mean, that's insanity. We're already in the 4th month of the year, so there's only 8 months left in the year. And they're talking about doing, basically, if they want to be at or over 3% by the end of the year, and we're at basically like 0.25 or 0.382, that is essentially 50 basis point hikes across the board, and that's roughly like 5 to 6 of them. So we're talking about a 50 basis point hike basically every like month and a half, averaged out till the end of the year. And then where does that put us at? I mean, look at where the 10-year is at right now. 10 years at 2.78. clearly broken out of that downtrend. And then on top of that, by the time we get up here near 3%, 3.2% is that previous high. So we have a technical breakout that's going to start threatening, a most recent high. And then if we break out of that high, we'll basically be at the highest point going all the way back to 2011. So that is a pretty serious deal right there. So again, we know the Fed is not the most intelligent and they're pretty much wrong about everything. But we do know that when the Fed says they're going to do something, they typically do it. Even if it's a horrible decision and, they have no idea what they're doing or no idea, what's going to happen, the consequences, etc. We know that for the most part, they're pretty straight up. They tell us what they're going to do and then they do it. So when they say they're going to run off $95 billion a month from the balance sheet, and we're going to start all of a sudden, not only are they not going to be buying, mortgage-backed securities, they're going to be essentially letting them run off into, basically that money going back into the market or new money not coming in to buy those. We know that that's basically destruction of demand. So we have a bunch of other things telling us there's destruction of demand that's about to take place from the consumer, from, businesses, investors, like the private sector. And then on top of that, we have the government, we have the Federal Reserve, basically saying, well, I shouldn't say government because they're technically not, but, they're at this point in time, they're basically married to the Treasury. So, but at this point in time, they're saying, we're going to let $35 billion in mortgage-backed securities run off. We're going to let, roughly $60 billion in treasuries run off the balance sheet. That is essentially destruction of demand because the Federal Reserve would be rebuying those to keep their balance sheet flat. But instead, they're going to let them run off of their balance sheet as they mature and then not repurchase new ones. So the balance sheet will start going down. So it's the equivalent of selling. Even though they're not technically selling, they're not buying what they would normally be buying. Therefore, they're essentially the equivalence of selling. It's destruction of demand. So we see a bunch of things that are pointing to massive amounts of destruction in demand in basically every single sector, every single portion of the economy, not only in the United States, but worldwide. And yet, everyone wants to try to be bullish right now. I think this is the absolute worst time to be bullish. This is the absolute worst time to be bullish. If something changes, by all means, we can change. When something breaks and the Fed changes direction and they come out, sure, we'll get right back on board, with the bullishness. But as of now, don't fight the Fed. That's, obviously it's not financial advice. You can do whatever you want. But in my opinion, we've already broken out of a clear downtrend. This is by far the most that we have ever been outside of this channel with a pretty decent amount of touch points since basically going back here to 1986 when we first started forming the channel. We essentially had one little kind of poke out of the top, and even that is not nearly as aggressive as what we're looking at here. And then if we actually switch this over to log scale, we also have my little obviously this is not something that you're going to see on anyone else's chart, but basically we have sort of like a rounding bottom and then a descending rounding kind of top as well. And again, we have broken out substantially from that rounding top. So we are much, much higher than where that is. And we're much higher than, oh, you know what? We have to disregard the numbers that I said earlier because I had it turned off of log scale and the fibs are all on log scale. So we're basically above the 886, headed back up to retest the high right there. So we actually broke out of the 786 and our target area back then. So regardless of what people think, what people want to say, when we look at the chart, when we look at the technicals, we see that we are basically going parabolic right now. The 200 simple is about to roll back over on the weekly bullish, and the 200 exponential is about to cross back over it. So basically everything is pointing towards extreme bullishness, and we've been extremely bullish on this the entire time. I'm not going to call the top on something the same way I don't like to call the bottoms on things, because this could keep running and going absolutely parabolic. When we see a massive candle, a blow off top, rejection of higher rates or something from the Fed changes, by all means, we can come in and start looking for a top. But I just really don't think now is the time to get bullish on bonds or bearish on, rates, especially when we're at zero still. So we have tagged the monthly 200 exponential and simple perfectly. So again, could this be just a hard rejection right here at the moving average? Every other time we basically hit the 200 exponential right here. We didn't quite make it to the 200 exponential or simple, and then we basically got rejected exactly at the 200 simple right there. No, I'm sorry, that's the, simple. So we didn't make it actually to the exponential because it flipped back on top shortly. Now they're both at the same spot, and we hit both of them. So we probably do get rejected sometime in the future. The real question is, do we see this blow off top, a little wick come up here on the monthly to 3.2 or something and retest this high, and then we get rejected back down below it? Do we stop right here and consolidate for a bit and then break out? We don't really know. But what we do know is we're seeing extremely bullish, indicators on our indicator oscillator. We're seeing extremely bullish signs across the board. I mean, the 200 exponential and simple on the monthly are basically flat right now. So literally, if we just stayed right here for another month or two, they would probably both flip blue. If these flip blue, that is literally going to be the first time since we had a little period right here where they were both blue at the same time in like 89. But in all reality, we technically like confirmed into a bear market back in like 86. So we're talking about, basically, I mean, 35, 36 years since these have been blue. And all of a sudden they're about to flip blue. They're very, very close to it. They essentially have almost a zero slope right now. I mean, I don't want to be the guy who says, things are different this time. But looking at this, I would say things look different this time. And even this rejection right here, we were not even that close to. They still had a pretty strong slope right here. We can see the difference between, I don't want to put the drawing tools on, but you can see them probably not that well, but the little crosshair dotted line, and you could see that there's still a pretty decent slope on these right now. Now, when we look at them right here, it's damn near flat. I mean, this is it. We're in the bullish control zone. The knife is pretty high up, obviously, but basically we are still strengthening to the upside on the blue and pink stochastics. So there's nothing telling us here like we're about to top out anytime soon. There's still a ways it can run, especially on a technical breakout of, almost 40 years. And then here we have blue slope on the TJD, TDMACD, a bunch of green histograms. 8 and 21 are across the upside aggressively. I mean, this is literally all bullish on the monthly. So do we get rejected here? It's possible. It's possible. But is it just as possible or even more likely that this thing keeps shooting up to the upside? And then if we get a technical breakout, that changes everything. That's that's basically bonds capitulating and the destruction of, trillions of dollars in capital, not to mention the, quote unquote safety play in people's portfolios getting absolutely wrecked is going to be a complete change in, sentiment. We are in probably the craziest times of most of our lives. And if not lives, at least most of our investing lives. So make sure you are using your brain and protecting your capital. Because I don't think most people are looking at things realistically. They're just looking at this as, oh, it worked last time. It worked for the last 10, 20, 30, 40 years. So I'll just keep doing what works. But it might not work this time. So here we have TLT putting in new lows, closing at new lows, and obviously headed down to our target as expected. So continuing just to get absolutely wrecked. I mean, we peaked out right here on that lower high peak in December of last year, around when the stock market peaked out as well. And that was at 154. Since then, we are down at 125 right now. So just from this lower high peak, 19%. So think about it like this. If you put $100 into, TLT or something like that, thinking, okay, I'm going to protect myself against inflation, or I'm going to look for appreciation of my investment, because a lot of people are buying bonds hoping that the bonds actually appreciate, or trading in and out of them hoping for actual capital appreciation, which is one reason why people would take like a negative yielding real bond. So if inflation's at 6%, let's say by the end of the year it averages out, let's say it kind of tapers off, and by the end of the year we average out at just a simple number, let's say 5%, and then the bonds are yielding roughly 2.5%. So you're losing 2.5% per year just by holding that bond. But if the bond's principal value appreciates by more than 2.5%, you're at least breaking even. And then maybe even more than that. Maybe the bonds appreciate by 10%, and then you can make that spread. So obviously you're getting the equivalence of like a quote unquote dividend or coupon on a bond, and then the actual appreciation of the underlying asset itself. So you can still beat inflation with that, and it's more of a safe play than what's considered like the stock market. In the opposite scenario, like what's taking place right now, you put $100 in this. Now your $100 is worth $81, and then you're going to get the equivalence of $2 or $3 for your coupon. So now you're up to like 80, let's say $3, so you're up to $84 out of your 100. And then on top of that, you're still getting your ass kicked by 5% inflation on top of that. So now you're back down to like 70, $8 out of your 100. So you have literally destroyed 22% of your principal with the safe bet. So, I mean, bonds are getting absolutely wrecked right now. This is literally like the worst start to a year, the worst year, and the most aggressive downturn in bonds. I mean, like in history, at least in like the last like 40, 60 years, something like that. So, in all reality, these are not normal times right now, and we should really be focusing on protecting principal, over so that we can grow it over time, because these times are crazy right now. So, in my opinion, it looks like we're headed down here to the bottom of the range, which is the bottom of the descending channel, as well as the bottom of our ascending channel that goes way, way further back. And that's somewhere around like 117, depending when we get there. And, as of now, it looks like we're there in a hurry. So it looks like probably what's going to happen is, just kind of winging this. Obviously, this is not rocket science, but it looks like we're probably going to come down to this level right here, bounce the bottom of this channel, and then probably see something like a push back up. And then after that, a more realistic like continuation of the down move. Now it is possible it just shoots straight to the downside, but I think that's probably less likely. So the next area we're looking for is, depending how aggressively this continues to sell off, it would not surprise me at all to see us at like 121, in the next few days or week. Obviously, momentum is shifting and going straight to the downside. I mean, this looks absolutely horrendous right now. I would not want to be in bonds. And who's typically in bonds? People that are probably, older, living off of a fixed income, either, combination of dividends and coupons. So, this is the people that can least afford to lose money because they're so far in their lives. Now, not everybody that's in bonds is old, but I mean, who do you know that's under the age of 40 that has over 20% allocation to bonds? Probably no one, because of the Fed's funds rate being so low for so long that we push people further and further out the risk curve. So you basically have to take risk. And then obviously the stock market does well because it's correlated directly to the Fed's balance sheet. So if we see the Fed balance sheet constantly going up, stock market constantly going up, people see realistically that it makes much more sense to be involved in, the bond market or the stock market than the bond market. So at this point in time, we are now revisiting the furthest back point we have is October 2011. This was the high back then. So we have over 11 years worth of value or appreciation completely wiped out at this point in time. And we have a peak before that we're coming close to touching as well from 2008. Now, obviously, the price action in the meantime has not been at those levels. That was our peaks. But, imagine investing at the worst time in 2008 or 2011 and then literally having ample opportunity for capital appreciation only to get completely wiped out, basically within the last like 2 years. Absolutely horrendous. And again, this is going to affect this is mostly going to be affecting, businesses and old people, just to keep it real. So looks absolutely horrendous right now. Switching to a longer time frame also, just to kind of look at our indicator oscillators as well. We can see we have clearly broken down from the 200 exponential and simple, clear rejection off of them. 200 simple is about to roll over and we're about to confirm into a bear market. We have been continuing to be inside the bearish control zone for some time now. All red histograms still have a blue slope, but only just for now. So the fact that the weekly hasn't even flipped technically bearish yet after this much damage has been done to the bond market, I mean, imagine what could come if this really does turn into an actual bear market. And you guys know, obviously, that our long-term target is the 200 exponential and simple down here on the monthly. Again, we have lost some monthly slope on the TJD, TDMACD. We had a false break back to the upside, just like we discussed right here for our head and shoulders. We have a breakdown of the neckline, and now we're seeing that measure move play out. That will likely take us down to that level. And then if we just turn back on the drawing tools, we'll see here that we basically have an ascending channel that we broke out of, and that coming down and testing the bottom level lines up perfectly with our ascending channel, descending channel, our 200 exponential and simple, and that is our macro bottom for where I think that, I don't want to say that we want to call the bottom right there, but there's basically at that point in time, if we look at where the 200 simple and 200 exponential will extend out to on the monthly, in line with the ascending channel, and then also our ascending channel and also our descending channel, this target here in green at around like, 117, 118, somewhere around there, seems like a very high likelihood area that we would either put in a macro bottom or at least see an aggressive bounce. So that is my target. If somebody said to me, I'm going to buy bonds, I don't know when I should do it, what should I look for? I would say this is not financial advice, but if it were me buying bonds, I would look for roughly this area right here where we see a massive amount of confluence on the monthly time frame chart. So that's what I would be looking at. If somebody was looking to buy bonds, somebody was looking to pick the bottom, that's where I would be looking for it. So obviously we could see a very aggressive, breakdown. We could see, all kinds of Chinese, Russian money, European money, all kinds of stuff, flowing out of the United States. We could see, loss of world reserve currency status, destruction of the dollar and dollar demand. We could see a lot of stuff that would make this maybe go much, much lower. But for now, without some crazy macro event taking place in the short term, I wouldn't expect any of those things to happen within like the next, 2, 5, 10, 20 years. So in all reality, and depending on what happens, like there's definitely a way that they could buy another 20 years out of the dollar. There's definitely a way that 5 years from now, it could be absolutely destroyed and gone. So I think somewhere in between is probably realistic. Like, the 5 to 10 year range is probably a little more realistic. But that would probably lead to a much more aggressive sell-off. But we don't want to count on what could happen. We want to count on the probability of something actually happening. So that's how I am looking at the bond market and treasury yield. And, again, don't fight the Fed. I mean, that's a great slogan on the way up when everybody's, recklessly investing, purchasing, speculating on a bubble. But when it's don't fight the Fed on the way down, all of a sudden everybody wants to be like, oh, they could never do it. They're not going to do it. They won't be able to do it. They can't do it. Well, don't fight the Fed. If they say they're going to do it, don't fight the Fed. If they change their mind, they're going to tell us, and they're going to tell us in advance. So U.S. oil next, obviously, closing down here. Well, I mean, it had a little bounce, but it has all but come down to the bottom of the triangle at this point in time. It did wick down slightly, basically a retest that low, but we're just still acting inside of this descending triangle rather. This is a bearish pattern at the top of a long bullish uptrend, and we have lost some key support levels. So in my opinion, this likely does break, and more likely than not, what ends up happening is, I like to do my measure move. You can do it from the top point to the bottom point. I like to do it from the middle point just because it is much more likely to play out. Sometimes it will underperform, sometimes it will overperform, but if we use a medium-sized measure move, we're much more likely to, be prepared for the bottom, not just expecting further downside. A lot of people will take from the top here to the bottom, and then they'll miss the trade every time because it never comes all the way down to their target. So the best thing to do is have it overshoot your target slightly, and then that way you don't miss it. You can always front run a longer target. You can always, ladder in once it hits your target. But the last thing you want to do is have it come all the way down to your target area and then miss your entry level and then shoot back up, which, is essentially what I expect oil, energy, etc. to do. So we have the 200 exponential and simple down here at a key fib level. But at this point in time, you guys know, I've talked about 100 times, somewhere between, the low to mid 60s and, our initial target of like 83 is what we're paying attention to. But it does look like this is planning to break to the downside. All right, so Dow Jones, this one actually finished decent. The rest of the markets finished pretty bad, pretty poorly. So here we have bounced the 200 exponential, and we are maintaining price action between the 200 exponential and simple. Not necessarily a good thing. We want to break through this. We want to come down and see an immediate rejection and continuation to the upside. It's possible we still get that. If we take out this high, if we start surging to the upside, things will look much, much better on this chart. But I do not think that is likely to happen. I think more likely than not, we are just going sideways while these moving averages just kind of flatten out, and then we're going to get a further breakdown and probably revisit new lows. We have looked at the long-term Dow Jones chart quite a few times. It is important. We'll look at the weekly real quick. It is important to note that even though it was technically a down week, barely, but it was technically a down week. If you take out, we talk about this all the time. On the way up, what do we see? We see a pretty steady grind of green candles on the way up. And then we typically see one big red candle or maybe two, and then a pretty typical grind on the way up, and then one big candle that's red, and then a pretty big grind on the way up, and then a big red candle, and then a pretty good grind on the way up, and then a big red candle. So that is the stairs up and the elevator down, which is what happens in a bull market. And then in a bear market, the opposite happens. We take the stairs down and then the elevator up. So the stairs down and then the elevator up. So this tells me even further that we're in a bear market. Like it or not, depending on, oh, we're not down 20%, so we're not in a bear market. Or, oh, well, we technically closed back above the 8 and 21, even though they're still across the downside. Oh, we did technically bounce back above the 200 exponential and simple, and the slope is positive, and you say that that's a bull market. Well, it's a bull market the first time, and then it's a bear market the first time. And then when we start seeing consolidation or moves around those levels, it's typically that reversion of the mean play. So this aggressive of a bullish candle is basically the elevator back up before we continue to take the stairs down, in my opinion. So we'll see what happens. This was obviously a decent close here on the weekly, so that is definitely a good sign. But nothing has really changed here. On the monthly, we're able to essentially get back on top of the 8, but we still have, obviously half the month left to go, but we see some bearishness on our indicator oscillators. So. And then if we look at the SPY, we start to see a little bit different of a picture. Again, the SPY still in between the 200 exponential and simple, hard sell, multiple red histograms. Looks okay, didn't close too bad. Obviously, was able to kind of rally up. The weekly does not look quite as good. A little more of an aggressive sell-off there. Basically taking out over 50% of this previous bullish candle and then wiping out the indecision candle right before it. We did close once again back above the 8 and 21. Which again is a good sign. If we stay up here long enough, we cross this back to the upside. But right now, it's looking like we're probably just going to put in a lower high. We are close to crossing back the stochastics and potentially getting a buy signal right here. So arguably, this could start looking more bullish in the near future. But overall, I think looking at the 4 major indexes, or looking at the various sectors in the market, and then some of the headwinds that we have talked about already, is probably the best thing to do right now. Not just trust the one thing that's saying, we could be bullish or we might be okay. I think, obviously depending on how you want to look at it, if we look at, 4 different indexes, major indexes, and then we look at, 11 sectors in the US stock market, or we look at, some cryptos, and we look at some other random stuff as well, or we look at a bunch of the stocks inside of these indexes, and we see a huge portion of these are all pointing bearishly to the downside, and then we can find 1 or 2 things and maybe a handful of stocks that are bullish. I don't think it's a good idea to disregard the 95% and then trust the 5% because it fits our agenda. I think it's a much better idea to look at it, non-biased and see what's really going on. Or at least be cautious if you are going to just go out on a whim. So IXIC, NASDAQ, obviously very, very bearish. Got rejected by the 200 exponential and simple. Could not even touch the 200 simple. Below them again and confirming once again down into a bear market. Closing below the 8 and 21. Looks very bad. And then obviously we closed back below the 8 and 21 on the weekly chart. We did get that hard buy signal on a really, really bearish weekly candle. So that is basically, a false alarm, a fake out. Could we see something like this where we have one more sell-off week, or maybe that was the bottom and then we continue to the upside? Sure, anything's possible. Anything is possible. And then the weekly, obviously, or monthly rather, looks obviously terrible. We reclosed at the lows. So we have basically this month, February, we closed at the lows. March, we rallied back up to retest the 8. We got rejected in the beginning of April. And then we're down here at the previous close and open lows. So we still have, 18 days, 19 days left in this month. But the last thing we want to see is a lower monthly close. So that weekly basically closed at the lows here. So if we see any more continuation to the downside that isn't a rally back up off of these levels, leaving behind basically a candle like this with a rejection of lower prices, it's going to look bad. So we still have 18, 19 days before that happens. Historically speaking, people are like, oh, but March and April are bullish months. Sure, okay. I mean, you can look at all the statistics you want and say that you're bullish because a month is historically bullish, but we're also in uncharted territory. So I don't know if I would trust that. We are at a key spot here on the TJD, TDMACD, the all red histograms coming down here to tag the slope line. very close to that. We typically do see a bounce at that level. And then obviously we have a hard sell signal and cross to the downside on the Jewel Thief. Looks pretty bad. The NASDAQ looks pretty bad. And then the Russell obviously looks horrendous as well. We tagged our target perfectly, got a rejection of the what was support. This entire distribution phase now has turned into resistance. Got rejected exactly at the 200 exponential moving average, and the support flipped resistance. Very clearly in a bear trend. Did not even get back up high enough to retest the 200 simple or attempt to flip this back to the upside. And now we have basically revisited the lows. So we're back down around the 236. It looks very likely that we're headed down here to the 382. So. And then on our weekly chart, again, very bad. We got clearly rejected off of the 8, closed back below the 21. And again, we are basically revisiting the lows. If we find support here at a higher low, it could technically look okay because we have a low, then a higher low, or I'm sorry, then a high, then a higher low, then a higher high, then a higher low once again. So we could technically start forming a tiny little, like, you know, bullish channel or some sort of like bullish pattern right here. But it doesn't look particularly great. Does not look particularly great. I would not trust that little bit of bullishness that we're seeing on what is probably the worst looking of the indexes. I think it's very likely we do come back down here and retest at least 200 exponential, if not the 382. So, and then our monthly chart is looking pretty bad as well. We have so far, obviously, you know, we still have 19 days till this closes, but we have very clearly like bearishly engulfed not only the last one candle, but the last 2 candles. And we are currently at the lowest point. Now, if we close right here, that would be a lower low close on the monthly. But again, we have been lower the last 3 months with you know, rejection wick to the downside. So we'll see what happens here. Doesn't look good. We have already technically lost the slope line. Again, we're technically at the area we would typically see some sort of support or bounce right here. Does not look good though. U.S. stock market looks pretty rough right now. At the time when people are like, I mean, I feel like more people are bullish on the stock market right now than they were at the absolute top, which is absolutely crazy to me. Just blows my mind. Blows my mind. I mean, people were very bearish or bullish in December, you know, when I was basically saying like, this is it, it's a wrap, and giving 100 reasons why, you know, this would be the top. And obviously so far it has been on most everything. And the same thing is happening again now. We were talking about the bullish divergence and the bounce or reversion of the mean play. It played out perfectly. And now all of a sudden, everybody was so bullish at the bottom, or bearish at the bottom, saying we're going to zero, stock market's going to crash, everything's horrible. And then all of a sudden it bounces back up a couple percent. We get the exact reversion of the mean play we see over and over and over again in all markets throughout history. And then all of a sudden now everyone's bullish. So they're bearish at the bottom and bullish at the top. So I would not trust, you know, what people think. So next we have the XLE, obviously still very strong, putting in another higher high right here. We discussed this. This is definitely what we expected. So now we have a high here, a higher high here, and a third higher high here. We have a high here, a lower high here, and then we're looking for a potential lower swing high here once again for triple bearish divergence between these points right here. And then once again, you know, we see obviously a high, a lower high, and then we're pushing back up here again. So we're just waiting to see, does this top out and then put in another lower high and, you know, potentially 3 drives of bearish divergence, followed by, you know, obviously some sort of aggressive pullback. I think it's less likely now because there's so much momentum and there's also not a lot of places that people can put their money. So things that are strong right now, because there's so few of them, tend to attract capital. So I wouldn't get overly bearish on the couple things that are performing well. So XTN transportation looks terrible. A new close on the daily, lowest close of this entire cycle at the 236 exactly. We look ready to break back down, retest the bottom of the channel, and then probably go much lower. You guys know we obviously still have the same targets. The weekly is just absolutely horrible. 821 rejection, and just, I mean, this thing is just getting absolutely crushed right now. So why is all of a sudden the transport sector, the thing that everybody needed, they couldn't find, it was going through the roof, you know, that was the reason for all this inflation, was all these shipping costs, and we had a shortage of truckers, and it was the, you know, containers coming across the, you know, across the ocean, and there was all these reasons for everything being so expensive, and it was all this, and yet here we are, everything's still expensive, transportation is getting absolutely wrecked, There's no longer these same shortages of labor, but yet something is still wrong. That's weird. Could it be, supply and demand dynamics? Oh, so wait a minute. Is it all the money printing? I mean, we had record money printing, and everybody was saying all this money printing was what was causing all this inflation. It wasn't bottlenecks in the supply chain. It wasn't any of those things. It was none of that. Oh, no, it's not that. It's all the money printing. It's all the money printing. And yet we still have not, we have had no new money being printed, quote unquote. We have, basically gridlock in the government in the United States. So there's no new stimulus programs. There's no new handouts. There's no new, quote unquote, money printing. And yet we're seeing highest levels of inflation. So what is that? It's the supply chain issues and the policy that is causing this, as we've been discussing this whole entire time. So we're still right on track. I mean, I didn't think it was going to get this bad, to tell you the truth. I don't think anybody did. But we're right on track. Everything still looks exactly like we've been discussing, literally 4 months. So I fully expect the same thing to happen. I expect transportation to be topping out right here. I expect transportation to come back down and retest those 70 levels. Again, I show this over and over again, but if there's any new viewers out there, every single time we go into one of these ascending channels on the monthly, we break down from it, and then we see a pretty juicy, downside, 35% when we break down from that channel right there. This one right here, break down from it again, we see an initial 25%, and then we see a final 47% breakdown. And this is, each of these channels is a couple years long. So this was that Rona multiple year channel right here. And then now here we are, basically having topped out off this blow off top, this very clear, shooting star. And we're down right now 21%. So if we just average down here and come back down to the 38.2% of that move to the upside, that's 32%. And that's our target, where we're looking to actually load back up on this. But in all reality, could we see a more aggressive one, a 50%, 48%, something like that? I don't see why not. So I think there's a very high likelihood we see this cyclical, continuation of these breakdowns from the ascending channels, and then essentially, heavy sell-offs. And obviously that's going to have to do with the economy slowing and, things not looking so bright. So that is transportation. And then obviously this is one of our 4 horsemen. We've been talking about the top in transportation and how important that was to determine if we're going into, confirming into recession or, potentially like depression territory. Next, we have financials. XLF closed back below the 200 exponential on the daily. It's starting to flip back over. Pretty flat right here. Do not like how this looks. Obviously, we've talked about all the headwinds for financial. Doesn't look good on the daily. Obviously, like around the center, the heart line of that channel. Weekly close was, it had a decent rejection, closed below the rejection of lower prices, aka a big wick on the bottom here. But doesn't look good. We really needed to hold that heart line on the weekly. And that is, it's not a new weekly close because obviously we have that close back down here. But, it basically just continues our downtrend, which is a high, a low, a lower high, a lower low, a lower high. And then it looks like we're headed back down here to put in another lower low, which I think somewhere around like that $35 range would probably be a good target for us to keep an eye out for. Let me actually put one of these on. Yeah, I mean, at this point in time, we had a decent amount of confluence on this, but nothing too crazy. I mean, coming back up to the 236 of the internal fib retracement. But yeah, I mean, this just, it does not look good, in my opinion. All right, and then we're getting into, the places where people are going to hide their money during uncertain times. I didn't even realize I hadn't been doing it for the last like week or two, but I meant to be showing healthcare and hadn't been showing it lately for whatever reason. So that is one other place where, we have talked about a bunch of times, a good place to hide during like recession, or like, financial uncertainty, along with like utilities, consumer staples, dividend stocks, and then obviously energy doing well right now, but healthcare as well. Because regardless, it's essentially a necessity. And that's why utilities are so important. Consumer staples are so important. Housing in general, very important. You know, all the stuff that people need, they don't really have a choice about. So we did finally come up here and tag our target. Do I think this is just topping out now? I mean, maybe temporarily now that we finally hit our target, but I don't think that, I think this is going to stay strong. So, you know, it basically just put in a new high. I mean, this is definitely just one of the safety places to be. So at this point in time, I think the best thing to do is just assume this is going to be putting in higher prices until it doesn't. I mean, we could take from that last swing high and go to the swing low and then put in a fib and then look for a Fibonacci extension to the upside from that previous high. Okay. So I guess the most recent TradingView like got rid of a lot of my settings, but it still has a 1.618, which would be 154. But we could put in like a 1.236 or like 1.5. Those play out pretty often as well. So be looking for those areas. So XLP, consumer staples, obviously another safety play. Did come up here and put in a new high. Looks very strong. It is very high on the range, but we're very much inside the bullish control zone. Just steady grinding, all green histograms. I mean, just again, all the money that everybody's wondering, where's it going? Where's it going to go? The money has to go somewhere. I mean, we know where it's going. We know where it's going. It's going into energy. It's going into healthcare. It's going into consumer staples. You know, it's going into utilities because they're the only things that are doing good. It's going to Apple. You know, there's the only things that are doing good. XLU, obviously, been talking about this one. Still have our target to the upside here. Still very strong. Starting to cool down a little bit. We had some pretty aggressive, you know, grinding higher, and now we're seeing a little bit more difficulty. Again, I wouldn't be surprised to see some of these like studs of sectors in the market kind of pull back a little bit, kind of cool off. But to tell you the truth, I think they're going to get bought up and bought up aggressively if and when they do. So real estate still looks strong. Again, kind of consolidating here. Still wouldn't put it past this to put in a giant head and shoulders pattern. But again, you know, is the rising rates going to be enough? I'm just not sure that this is going to be slow, so slow to react. I think the key thing we need to look for before we start getting bearish on real estate is we have to look at like some of the metrics for real estate, specifically in the area that we're paying attention to or investing in, or just like overall general metrics like, you know, days on market, like how long a listing has been on the market for on average, like short end, long end, and then just average overall. Seeing like how many markdowns we see in prices. Do we see, you know, on average 30% of houses are getting a 10% markdown? Do we see, you know, 50% of houses getting a 20% markdown? You know, we have to look for basically, you know, those type of metrics. So we can see more in certain areas than others. Other things like that as well. Just general metrics specific to areas we're looking to invest in. You know, or if you're buying into an index or something like that in your own country or in the United States, looking at those type of metrics like worldwide or statewide or, you know, just in your region, etc. Is it possible that this thing just rolls over? I mean, and we put in like head and shoulders? Yeah, it is possible. I wouldn't get too excited for it right now just because we're still seeing a lot of strength from this. And again, the money has to go somewhere. So I don't want to get overly bearish on real estate just because it lags so far behind the actual metrics. So when we look at like home builders and stuff like that, they're getting absolutely destroyed right now. You know, with the exception of a couple of the bigger names that aren't looking as bad, but still looking terrible. But again, it's what we talked about earlier. Intelligent people, good businesses, smart investors do not build things when prices for the goods and the services, you know, aka lumber, concrete, you know, windows, siding, all the materials that you need to build a house, and then all the labor that you need to build a house at record highs. That's not when you build. That's not when you all of a sudden start building a bunch of houses. That's not when you buy. That's not when you build. That's absolutely the worst possible time because you're assuming, especially on something like a house, where it might take, you know, a month to get built. It might take 2 months. It might take 6. Right now, it might take 9. It might take 12. It might take more because you're having trouble with labor or getting the supplies or, you know, whatever regulations, etc. You don't know what the market or what the, you know, environment is going to look like. We don't know what rates are going to be. You know, if you put down on a house depending on what kind of contract you get, and they start building it, and then it takes them a year, maybe even more, to build that house. And then by the time the house is done, you now have a 3% or 5% or 10% down on the house. And then all of a sudden, the mortgage rate that you thought you were going to get was 2.5%, but in actuality, by the time it's done, it's 7%. You might not even be able to afford that house anymore. You might have to actually just walk away from your down payment, or, not have a choice. Or maybe the value of the houses surrounding that area may have dropped by enough at that point in time that it's not worth it. If you pay, if you buy a $250,000 house and you put down 10%, $25,000, and then all of a sudden the market is down 15%, by the time you go to move in, or maybe 20%, now you're already upside down on the actual value of the house that you paid for it, that you financed. And, there's a situation, especially if you get one of these crazy loans where you're putting down 3% or 5%, there's a situation where you're actually better off just walking away from that and then just turning around and buying one of the other houses in the neighborhood. So, got to really watch the real estate market, especially, depending on where you are located at. Obviously, it could be much different. I mean, if you're in a coastal city, it's probably going to be better than, like the middle of the country, obviously depending worldwide, etc. Or, if you're in like a big city versus in the suburbs versus in the boonies or boondocks. I'm not sure if anybody else is familiar with like that kind of slang, but basically out in the middle of the country. The country. If you ain't got a Walmart within 25 minutes of you, you living in the boonies, boy. Ooh, I tell you what. So next we have the VWO, Vanguard FTSE Emerging Market ETF, consolidating at the lows right here. You guys know my view on this. Until we break back into this channel and consolidate above the green line, or until we break down below the blue line, I'm still just bearish on this. I still think it's just a matter of time before it just melts back down and revisit the lows. And that is something like 40 or 50% China. So DAX Germany, again, lost the 821, closed down below it. There's still some hope right here. We basically closed at it, but below it, but it did cross back down. Looks like this thing is headed back lower. Best case scenario for both these is that they basically just put in a higher low and then start to consolidate, come back up, put in a higher high, and then move up. But to tell you the truth, if you were like, hey, what's the one country that you should definitely not invest in right now? I would be like, the one country I shouldn't invest in, probably Germany. Probably Germany. Why do I say that? Well, now, I mean, Germany's obviously having serious issues because of their wokeness, or their green agenda, or whatever you want to call it. They're making horrible decisions, in regards to nuclear reactors and shutting them down, and basically completely screwing themselves over by horrible decisions and horrible policy. And they're extremely reliant on Russia. Obviously, they got put in a really bad situation, with the pipeline and everything. And then on top of that, everybody's quote unquote sanctioning Russia, and it's like, oh, Russia's bad, and they're all like virtue signaling, but they're still buying Russian oil. And now Germany's going to come out and say, and we're only going to do it for a little longer. We need it, but soon we'll be off of it. We're weaning ourselves off, even though we're still buying as much or more than we've ever bought before. And then now all of a sudden we're going to but we're not going to buy Russian coal either anymore. So you're going to shut down all your nuclear power plants. You're going to not buy Russian oil or Russian coal anymore. And then somehow the future of your country is going to be bright? Probably not. Probably not. I mean, but what do I know? That does not look good to me. Looks, this is the worst country, one of the worst countries to invest in right now. No offense if you're German, live in Germany, or, love Germany. I have nothing against it, but they're just making some of the worst decisions. I mean, the people in charge of all these countries right now they are like anything you could possibly mess up, they're doing, in my opinion. Not just Germany, not just Europe, everywhere. United States, everywhere. All these leaders have no idea what they're doing, in my opinion. So would not be surprised to see the DAX back down here at somewhere around like the 200 exponential and simple on like the weekly. It looks very weak. Looks very weak. Really needs to reclaim these levels, consolidate, and then start moving higher. But again, there's nothing that really tells me all of a sudden things are just going to be good for Germany. CN50, so again, still trying to cross the 821 back to the upside. Now, while this has happened, it's important we pay attention to the fact that the indicator oscillators have moved all the way from the bottom of the range to the top of the range. Here we were at basically the bottom of the range before this little capitulation dump and then pump right here. That was at 13,678. So now we're at 13,9. And in the meantime, the indicator oscillators have moved all the way back to the top of the range. So that to me is a bearish reset. It's the indicator oscillators moving all the way back up while price goes sideways. And then eventually this is going to have to go back down because it oscillates from the bottom of the range to the top of the range. So, you would probably reason that it's going to eventually go back down to the bottom of the range. But the price is in the same spot now. So when it goes to the bottom of the range, it's probably going to be much lower on the chart. So China, in my opinion, doesn't look good. And right now they're reporting more cases on the Rona than they were at the peak. Now, granted, obviously we can't trust anything that China does or says. Nothing against, again, Chinese people, but the government, the Communist Party, absolutely liars. We can't trust anything. I don't trust their GDP numbers. I don't trust any of their numbers. I don't trust their Rona numbers. None of it. But right now, all of a sudden, they're reporting the worst numbers of the entire time. I mean, that can't be good. It definitely doesn't look good on paper. It's not good for the global economy since everybody buys everything from China. UK 100, retesting those highs once again. This is the one we got to be real careful on. It does look strong that it's retesting these highs, but it also looks very, very toppy. Looks like this thing is getting ready to sell off. So wouldn't surprise me to see a big push to the upside, a rejection candle, and then that's our top essentially. So that's what we're paying attention to. Not going to be surprised if this takes out that previous swing high right here. But remember, we tagged the 382 perfectly from this whole entire move to the upside. So, a lot of times that is confirming that we have topped out. Now, a bullish retrace of a Fibonacci could be the 382, and then it just continues ripping to the upside. So it is possible that this has actually bottomed, and UK is just going to get strong and just keep bumping up here. I don't think it's likely, but it's definitely possible. I think it's more likely we push to the upside, we see a temporary rejection of higher prices, a blow off top or throw over, and then we actually go lower or consolidate. EWZ, Brazil. Looks okay still for now. The longer it can just consolidate above the $34 level and the 200 exponential and simple, the better it looks. I really think this needs to come back down and cool off for a little bit, and then I think it goes much higher. I mean, this is commodity driven, obviously, so they have a massive amount of commodity exports that are all at record highs. So let me jump over in the chat, and then we'll keep ripping on through. What's going on? Where did I leave off? I think I said hey to Emad. Good to see you. Peter Gerd says, yes, you need to talk more like that. I'm not sure which part you're talking about, man. That could be so old. Triple Dump says, good evening. I'd laugh every time I see that. That's so funny. Good evening. Gonna have to rewind the stream later. Yeah, for sure, my man. Glad you made it. Make sure you guys smash up that like button. Let's keep ripping on through here. We'll do crypto after this, and then we'll finish up with uranium. So DXY, still very strong. I mean, this thing has got to put in some kind of bearish divergence top sometime in the near future. It's at 100. That's a pretty strong level. I mean, this thing has just been so strong. I mean, I guess we don't want to just pick the top on this by any means. I think if we're going to pick a top, it would be a nice round, even 100. And then see it cool off for a little bit. But you guys know how I feel about the dollar long term. It's extremely, extremely bullish. We have already taken out and closed above the March 2020 top. So, I mean, at this point in time, well, I guess on the monthly, we haven't technically closed above it yet. But we're above it right now. So if we close above the 2020 top or 2019 top, depending on how you're looking at it, if we close above that this month, it's going to look very, very bullish because at that point in time, there's basically a couple candles and just one more higher peak, and then it's a macro cycle high, and the cycle having started back in 2008. So, the dollar is close to, basically 13-year highs, DXY. So for all the people that were calling for, strong bond market and weak dollar, well, I mean, you're the wrongest person in existence. So good job. Congratulations. You know nothing. On the weekly chart, we have closed up here. Okay, so yeah, on the weekly chart, we can keep watching this one because it's going to give us a little more relevant data in a little less time. So if we see this week close up here above 102, that's going to be really, really bullish because at that point in time, 103 is basically like a macro weekly high. So I think that's the level we really need to watch out for. Very, very bullish on the weekly. And then on the monthly, obviously, we confirmed into a bull market. So at this point in time, no one should be bearish on the DXY at all. I mean, you got to be crazy to look at this chart and think this is bearish. This looks like literally the best opportunity to be involved in something. It has not been in a bull trend since we crossed down in 1986. So we have confirmed a bull market. Even here, we never confirmed the bull market because the 200 simple was still angled down. So for the first time since we left the bull market and confirmed the bear market in 1980, let's say roughly 6, we're in a bull market. We're close to breaking out of that same downtrend in the treasury yields as well. So we're literally talking about uncharted territory that we have not dealt with something like this in 35 years. So anybody that's looking at data points for the last 35 years saying, well, the last couple times this happened, X meant Y. Well, not anymore. Things are different this time, for real. And I'm not even joking. So, yeah, we'll see how this next weekly and monthly close, and then that will give us a little bit of a more clear picture on the dollar, but it just looks very, very strong. Very strong. Tesla, so topped out back here at the top of the channel, sold off a little bit. So we have officially, we had already pretty much closed the gap. I think we were talking about it coming down here. So I would expect a retest of like $900. If $1,000 holds, it's going to look pretty bullish. And then we start moving back to the upside, and then I would look for new all-time highs. Realistically, though, I think we're probably headed down to 900. Looks like it's rolling back over. ARKK, that was just a moment of silence. I'm not even gonna do it today. I'm just gonna mix it up. Not even gonna do it because you guys already know. You already know. SMH, semiconductor ETF. Damn near closing at the cycle lows at this point in time. So this looks terrible, terrible. And you guys know, obviously, I have talked. This confirmed into a bear market now officially. Strong rejection. So you guys know we looked at transportation, and it looks like it's putting in a cycle high. We're looking at semiconductors confirming into a bear market, looking like they're putting in a cycle highs. Well, how can that be possible when everybody's waiting on all these semiconductors? Because capacity, it's done. The money's already been spent. The semiconductors have already been ordered. Everybody's waiting on them. And then now it's a multi-year waiting game to just get them. But there's no more appreciation in the stock or multiple expansion or increase in value because they can't match production. They can't increase production. It's such a slow, laggy, like cyclical type thing. It's something crazy. I can't remember the exact stats, but I think from when they start manufacturing the first piece of a semiconductor to when it's actually finished, it's like 18 months because it's got to have a bunch of serious steps to take place. It's got to get shipped around the world multiple times because certain areas have the foundry, certain areas do, like the finishing touches. So when it's all said and done, there's so much lag in the semiconductor market that essentially I think everything's been priced in, and this is topping out. It's been extremely, extremely aggressive. We saw something similar in the, March Rona dump right here. But this is even then, the chart did not look this bad because it was just like a straight down drop and then V bottom. Here, we basically look like, we're basically confirming into an actual bear market. Here, we didn't even confirm. This happened so fast that we never even came close to confirming into a bear market. 200 exponential flipped. I guess technically at the very bottom, there was like 1 day in time that it flipped into a bear market, but only because it was such an aggressive dump and then immediately rallied back up. The last time before that we confirmed into a bear market was the retest coming out of the actual bear market in 2018. So 2018 we had a bear market, then we went parabolic out of it, came back down, retested it, found support, and then, see you later. And then obviously that was the Rona dump, and now we see, we're basically confirming into the strongest bear market that we have seen in, literally years. So it does not look good to me. And, again, that's one of the 4 horsemen. That's one of the most important sectors or ETFs to watch. We are also very clearly have the 821 cross, came back up, got rejected. Reversion of the mean play, rejection, and then, I mean, look at this massive red candle, revisiting the lows right here on the weekly. So there's a very high probability, assuming this thing doesn't just bottom and then move back to the upside and just start going parabolic, there's a very high probability we're about to lose key support. We're already back at those January 2021 levels. So, the last really like support that we have to kind of hold on to is here. At which point in time, we really need to start looking at fibs. So if we look at our fib going back to March of 2020, the Rona dump, and then we put it at our top right here, which we nailed our top perfectly. We got our breakout. This thing traded very, very technically the whole way up and hit our targets perfectly to the upside. And that being said, now we have broken down from the ascending channel. We're losing key levels of support, and now we're about to tag the 236 a second time. Well, we already tagged it once, and we got our nice bounce. So at this point in time, the 382 looks probable. So that's what I'm looking for. Basically, a move down to the 382, and that is probably our next target. So we will make that one green, and that is the area we'll be looking for, which is right around 200. Nice round number. 200 exponential will probably be there when we get there. Somewhere around like May, something like that. Seems very, very likely. Very, very likely. And then if we look back at our previous times, this was the run up from 18 to, the Rona dump, and that was over a 61.8% move. Somewhere around like probably 65% or something like that for all those golden pocket guys out there. So if we saw something that aggressive, it was also the 200 exponential and simple. So, if we saw something as aggressive as the 382, that would take us to 200 exponential. If we saw closer to the 0.5, that would take us to 200 simple. If we saw something closer to like 618, that would be a revisit of the highs right before the Rona dump, which is the same thing we see on the Dow Jones. It's the same thing we see on a lot of the other indexes. So in my opinion, there's a very strong correlation between a lot of these different markets that are all pointing to a retest of the 2018 highs. So if you think about how much extra money went into all these markets and how much extra bullishness, how much Fed hand-holding we saw taking place, stimulus, all the things that we saw taking place, the increase of the Fed's balance sheet, almost double, $5 trillion, almost $9 to $10 trillion spent into the economy, in the United States alone, not to mention the rest of the world too. I mean, we're talking about $25, $30 trillion got spent in these markets, and there's a high likelihood that we're going to go back and retest those Rona highs, before the Rona dump. I mean, so what did all that money do? It did nothing. It did absolutely nothing, because nothing got built, nothing got made, nothing got created. It all went into like rampant speculation. If anything, the world is worse off for it, because we closed down production. We closed down the production of goods. We closed down, services all over the world, locked everybody down, made up all the money and more through stimulus, through, Federal Reserve balance sheet increases, through all the central bank, monetary and fiscal policy that took place. And yet here we are about to be right back in that same situation again. And a lot of things have already come back down and retested that level or even gone lower. So, I mean, what does that tell you? It tells you that whatever they're doing is not working. What they're doing is not working. They're wasting money trying to do something over and over again that's not working. Nvidia looks bad. I mean, slightly better, but I mean, very, very weak. Netflix just looks absolutely terrible. Closing, at this same support from multiple times. Looks ready to revisit the lows right here. It's rolling back over. It's got earnings coming up. I mean, I don't know how that's going to go, but I mean, considering what's going on here, I would say probably not good. Probably not good. I mean, if this is what it looks like when they have good earnings, they top out, and this is what it looks like when they have good earnings, they have a dead cat bounce and then go lower. I mean, what's it going to look like if this is a miss? I mean, Netflix is just going to let go. And at that point in time, we're talking about that 260 level. So that's what I'm looking for. When they report earnings, I mean, it's still, what is it? Period ending March 22nd. They report on April 19th. So, I mean, look for the big options plays on Netflix. And, I mean, the amount of insider trading, you just watch what the options market does and then just do that too. Because it's probably just the insiders. I mean, it's not like there's any like regulatory bodies or anyone watching that would like stop people from doing illegal stuff. I mean, no one cares, obviously. Apple, still strong, arguably the strongest, But looks like it's rolling over here a little bit. Close below the 821. I mean, if it comes back down here and retests the 200 exponential and simple again, it's not going to be good. If it takes out this low, it's really not going to be good. But as of now, I mean, it technically has a lower high. So even though we took this one out and it looked kind of bullish, putting in a lower high right here is not going to be good. And then, yeah, we'll have to just keep an eye on that. But, you know, that's basically the strongest stock in the market that's not putting in new all-time highs right now. And then Facebook, you know, obviously still just complete trash. Doesn't look good. Had all the opportunity in the world to close that gap. Google, you know, basically has flipped over the 200 exponential, closed below it on that daily close. Not good. 200 simple is still going to take a little while to roll over, but this looks very bearish. Bunch of red histograms, hard sell signal. I mean, that's a pretty juicy red candle right there. I mean, it looks, it technically lost support right there, but we give it the benefit of the doubt. If their area holds, the 821 we're trying to cross the upside and it just got rejected. So in all reality, we're probably coming back down to 2,500. And then realistically, I mean, the real target is 2,342. And I mean, just look how far away from the 200 exponential and simple moving average that is. So, I mean, what does this tell you? Probably like business ad revenue is probably going to be going way down, and that's going to hurt them. And then Amazon, again, just, you know, another lower high, another just complete meltdown. You know, we had a beautiful reversion to the mean play, rejected, and, you know, confirming it back into a bear market. Looks like it is ready to head much, much lower. At least to retest the lows. It looks like, you know, we basically front ran the 200 exponential and simple twice. So this time I think we probably tag it. I would expect hard support around like 25 to 2600. And that's probably going to be a good entry opportunity. I don't think it's going to go down to like 2000 anytime soon. You know, we'll have to see. Again, you never know with Amazon either, when they're just going to come out with some more like stock split news and then everybody's just going to get all pumped up on it again. You know, I think it's like a 20-to-1 stock split has been, you know, announced, confirmed, discussed, whatever. So I think that that will be an overall bullish catalyst. You know, it's not as important when something's like $200 or $300 or something like that. But when you see like a 3,000 or 5,000 or, you know, $30,000 stock or something like that split, it makes it much more affordable to people, which shouldn't actually be relevant because of, you know, fractional shares where you can buy like, you know, 10% of an Amazon stock for $300. But for whatever reason, just like a mentality thing, same with cryptos, like people want to own whole coins. A lot of times people will be like, I don't want to buy Bitcoin. It's $42,000. I'll just buy like, you know, something that's $200 or, you know, whatever it is. Buy something that's $3,000 because I can get a whole Ethereum or I can get, you know, a part of a Bitcoin. So there's still like that kind of bias to people wanting to purchase like full stocks or full crypto coins or tokens or whatever. So I think honestly, even though there's technically, you're just cutting up you have the same pie and now it's a whole pie and then you're just cutting it up into 20 pieces and then you're offering people a piece of the pie when before they could have just bought a piece of the pie. But now you're saying each one is a whole pie. It's just a much smaller whole pie. For whatever reason, people are like, yeah, I'll take one of those whole pies. You know, and that's kind of how they look at it. So, you know, is Amazon a lot more appealing to people at $150 than it is at $3,000? I really think it is, especially when people are doing like, you know, when they have a set amount that they're putting into a fund every month or buying their own stocks with or whatever. Again, people are less likely to be like, I'll buy 10% of an Amazon stock. I think if Amazon's, you know, $150, people will be like, oh, I'll slap another Amazon, you know, in my portfolio. But again, you know, it's all just psychology. In the end, it really, there's no difference. You're just dividing up the pie differently, but it's the same pie. So now let's go to cryptos. Triple Dump says, someone theorizes that once DXY tops out and retrace, crypto and stocks will bounce back hard. Thoughts? Someone theorizes that once DXY tops out and retraces, crypto and stocks will bounce back hard. Thoughts? I mean, here's the thing. We've looked at the correlation between like cryptos and stocks and the DXY quite a few times. As a matter of fact, we did it with gold and we did it with rates and bonds as well. And there has been different periods in time for like years when they have been correlated or inversely correlated. There has been months in time where they were correlated and inversely correlated. And then there has actually been like put them all next to each other, compared them on the same chart. We've done a bunch of different stuff. And there's been times where certain things were positively correlated and then they flipped to negatively correlated, etc. So I wouldn't be, I don't see anything right now that would tell me that. Because if we look at basically, look at where the dollar, let's look at this real quick and then we'll get into crypto. If we look at the dollar right here and just do a, quick kind of just take on it. The dollar bottomed out in January of 2021, and then basically double bottomed in May of 2021. But it's been on an uptrend since then, and it has flipped into a bull market, technically like confirming right around like August of 2021. So January was technically the bottom in 2021. And then if we look at like our major indexes, and we see where was the Dow Jones at in January of 2021. This was the Dow. So if anything, technically the Dow and the dollar were pretty correlated because they both went up, that whole entire time. It wasn't until basically January of 2022 that the stock market topped out. So if the stocks topped out in January 2022 where the Dow did and then started going down since then, I mean, is there any correlation between that and what's happening in the dollar? I mean, not really, right? This was January 2022. So this was basically the bottom right here. So the Dow Jones was going up the whole time the dollar was going up. And then the dollar had a pullback right here. The Dow Jones topped right here. And then all of a sudden the Dow Jones started going down. So they were correlated the whole time. And now they're inversely correlated because the dollar's just melting up and the Dow Jones is going down. So, I mean, there's not really a correlation unless all of a sudden something happened right here that made them lose their correlation. But right up until then, they were completely correlated. And then if we look at Bitcoin, we look at January of, wait, did we say, what was it, 2020? No, 2021 was the low, wasn't it? Damn it. What year is it? What month is it? Yeah, 21. Okay. Sorry. Sometimes when I use the tide machine, it throws me off. I have trouble getting my bearing afterwards. Okay, so this is January 2021 in Bitcoin. So this is when the dollar was bottoming right here. And then the dollar was bottoming and then going up. And then Bitcoin continued to go up with the dollar. And then it topped in April of 2021. Then it came back down in July of 2021. Then it came back up and put in a new high in November of 2021. So what correlation is there? Bitcoin was actually putting in new highs while the dollar was putting in new highs. And then November 2021, it topped out and started coming down and confirming into a bear market. So what correlation is there? I just don't see any correlation between and obviously if we look at the Bitcoin chart or, the NASDAQ chart, they basically look more similar than any other two charts out there. I mean, obviously all cryptos or crypto in general, because if we look at like the crypto market cap chart, it looks exactly like the Bitcoin chart. I mean, almost to a T. So there's no real correlation there. And then even if we look at gold, we've talked about this before as well. This was another one that we compared to it. Looking at gold from January of 2021, gold had already actually put in its top back here in August of 2020. And then in January 2021, it was selling off, and then it bottomed out here in March of 2021. And then it basically has gone sideways the entire time. And then now it's putting in a new high. So there's not really any correlation between any of these things. I mean, it's not really like negative correlation. It's not really positive correlation. And the reason is because there's so many other factors. You almost would have to look at, I think if you took the dollar and rates and then mash them together into like a single average, that you would have a better way of gauging them towards gold or towards equities. Because in all reality, the DXY has strengthened and the, treasury yields have strengthened also almost, like in lockstep. This was August of 2020 when this put in its bottom, and then it's been going up the whole time. This was January in 2021, and then it continued up, came back down, retested that high, and now it's melting up. So as long as the yields are going up, and as long as the dollar is strengthening, we're less likely to get a bull market in gold. But when people get scared of the stock market and run from stocks, they put their money where it's safe, which is typically in dollars and gold or bonds. But because bonds have been selling off and obviously the yield is going up, they're less likely to put their money in bonds. Actually, the money's coming out of bonds, which is pushing the yield up on the treasuries, which is then forcing people to either go to stocks, gold, or the dollar. Obviously crypto, I'm just counting as a stock right now. Basically just another tech stock. So in all reality, what we're seeing is the correlation between all of the different ones in relation where the money goes. But in all reality, I don't see any direct correlation between Bitcoin and, like the dollar. I don't think all of a sudden the dollar tops out and that money goes into gold, because it's not actually the strength of the dollar itself. It's the dollar in comparison to foreign currencies. So the DXY has nothing to do whatsoever with actual like strength of the dollar itself. That matter of fact, if you're going to measure the strength of the dollar itself, you just look at all the other assets on like a fixed scale, and then you can see, okay, if all these assets are going up, the buying power of the dollar is going down, right? I mean, if the price of Bitcoin has gone up by, what was it? I mean, I don't even know. Let's just take from, $4,000 at its bottom. It has gone up to, $40,000 or $70,000, however you want to measure it. Your buying power of the dollar is going down in relation to Bitcoin. So if gold was at, $1,300 and now gold is at $1,900, the buying power of your dollar has been going down the entire time. So if the stock market was at, whatever index we want to look at, and then putting in new all-time highs for the last 2 years, the buying power of your dollar has been going down. So as long as all these assets you would purchase with your dollars or whatever currency in relation are going up, the buying power of your dollar is going down. So that's not the same as the DXY. The DXY is literally the relationship of the dollar to foreign currencies that are in that basket, or just as a broad range of foreign, currency in general. So in all reality, you're not going to find a direct correlation like that. If anything, what you're going to see by looking at the dollar and the strength of the DXY, you're going to see, is it better for you to put your money in, depending on how you look at it, foreign or domestic assets, or is it better for you to be investing in assets in the United States, or is it better to be investing in assets in Canada or United Kingdom or Europe? And what that DXY chart is telling you right now is that compared to, Canada, United Kingdom, Europe, and the other really small components of the DXY, the place to be is the United States. That's what the strength of the DXY is telling you. So anybody that's saying that, the dollar is going to top out and then everything else is going to rally doesn't understand how it works, because there's no there's no reason behind it. There would be no actual formula that would mean oh, the dollar is topping out, so all of a sudden it's losing strength compared to other currencies around the world, so now Bitcoin can rally. It doesn't make sense. It makes no sense. For sure, man. And I'm not attacking you or anything. It's not on you. It's just so many people talk about all this FUD or spit all these theories or ideas or whatever, but they don't actually understand them. That's one of my biggest problems with YouTube is, I can watch a lot of content creators or whatever, and half the stuff they're saying, they don't even understand. You can tell that a lot of, especially big content creators, are literally going out, reading about something, learning just enough of it to know more than their audience is, and then pretending to teach it to them when they don't even understand it. And that's the problem with all these different things. It's the same thing with Russia, pegging the ruble to gold. Everybody is asking about, I've had family members ask me about it. Everybody's talking about, oh, so this is huge. Gold's going to go through the roof, right? But it doesn't actually make sense what they're saying, because Russia is only agreeing to buy gold below market value. So that doesn't actually strengthen gold. If I literally, take an extreme example, I was talking about this in the group, and I'm just going to go on a little tangent here, just because it's important, and I've had a ton of people asking me about this. So I know it's a big misconception or point of note or confusion or whatever. If you have a house, say we're playing Monopoly, okay, and you have your houses and your hotels and everything, and we're all just playing this game, and there's a limited amount of money, a limited amount of properties, a limited amount of everything. Okay, so now in this example, we're going to use gold to represent like the houses. So if all of a sudden, the banker comes in and says, hey, from now on, I'm going to put a floor under houses. So I think houses are 500 and hotels are 1,000 normally in the game. So you say, I'm going to put a floor under houses. So from now on, I'll buy any houses for $5. Did it really put a floor under houses? Because houses already cost $500 to buy from the bank. And if you're going to buy it from another player, they're probably going to want to get at least 500, maybe more, or maybe if they're in a pinch, a little bit less. But no one is selling houses for $5. So who cares? That doesn't do anything. What does that do for houses? Oh, okay, we can't sell our houses for less than $5. Oh my God. Oh, Russia, you're really sticking it to us with these no houses below $5. You'll buy them all. Like, is anybody going to rush and line up to sell Russia their houses for $5? No, it doesn't make any sense. So think about it like this. What they're really doing has nothing to do with gold. It's actually the opposite. What Russia is saying is, hey, you have to buy your oil from us, or our oil. You have to buy the oil that you want to buy from us in either gold, rubles, or your currency. That's normally how you make a purchase. Or, US dollars or euros or whatever it is. And Russia is saying, we no longer will accept anything but gold or rubles. And you're like, okay, that sucks. So I'll just go to the bank and I'll exchange my currency for gold or rubles. So then you look at, well, what's the best deal? Well, Russia says, we'll buy any gold from you at $1,500 or whatever. Well, gold is currently trading at $1,900. So that's like 20% less. So you'll give me 80% credit for my money if I pay you in gold. You won't accept my regular currency, or you will basically say, or you can buy these rubles, and then you can pay me in rubles. So essentially what's happening is they're basically saying, we don't want your gold, but we will take it, but we're only going to give you 80% of its value. We'll buy it for much lower than market price. So then what are you going to do? Anyone intelligent is going to say, well, I'm not going to pay you in gold then. So does it sound like Russia's trying to get people's gold? No. It sounds like they want people to pay them in rubles. So what does that do? If they're pegging, quote unquote, gold to the ruble, and they're pegging gold at a lower value than its actual value around the world, but they're only willing to buy your gold below market value, what they're really doing is they're fake inflating the value of the ruble. They're pushing up the value of the ruble, because now if you take your gold and you buy rubles with it, they're undervaluing gold, which means they're overvaluing rubles. So now if you go buy rubles, that basically you're buying overvalued rubles, and then they're giving you full credit for them, or you can give them any gold, but they're going to give you partial credit for it. So essentially what they're doing is they're trying to prop up the ruble, and it's actually working. I mean, it's working for now. So any argument anyone says about, oh, they're going to crash the, gold market, they're going to, get rid of all the paper gold, gold's going to spike through the roof. Well, that's the opposite. If they wanted gold to all of a sudden go up in value massively, they would do the opposite. They would say, okay, from now on, you want to buy our oil from us? We'll either give you 1 unit of oil for X amount of rubles, or we will give you, 1 unit of oil for gold, and we're valuing gold at, let's say, $3,000. So now everybody's going to say, whoa, gold at 3,000, but gold's only worth 1,900. So everybody that wants to buy oil from them now rushes out and buys gold. That creates a massive amount of, demand for gold, and then artificially drives up the price of gold to where everybody's going to start selling it for $3,000, or else they're going to start arbitraging the difference anyway, because then you can run and take that to Russia, and Russia's giving you, 2x credit for it. So it's the opposite. Anyone that's saying this is bullish for gold is not smart. They don't understand how the system works. It's the exact opposite. If you want to create massive demand for gold, you want to break the gold market, you want to crash all the paper gold, you want to get all the gold, you pay people over asking price for it. And then eventually the market will level out somewhere between the actual amount you're willing to pay them. If they said $3,000, maybe the market for gold around the world would level out around $2,700, because it's not worth the arbitrage difference for most people to go out and buy like Russian oil or food or whatever. But that's not what they're doing. They're saying they're going to buy it for less. They're going to give you less credit if you pay them in gold. They're not going to accept your other currency. And then if you pay them in rubles, they'll give you bonus credit. So they're overvaluing the rubles in exchange. So it's actually the opposite. They're trying to break the ruble market technically based on like that. So everybody's writing all these long articles and talking about how this is hugely bullish for gold and this is going to be the big thing that sends gold through the roof and this is it. But they don't understand it. They're all wrong. Every one of them is wrong. And I mean, what did we spend 5 minutes talking about that? I don't understand how the entire internet doesn't understand that. And then we can talk through it in 5 minutes. You could explain it to a child like that. If you want something to go up in price, you offer to buy all of them at that price. Think about it at iPhones, okay? If Apple came out all of a sudden and was like, hey, I know everybody just like can trade in their iPhone or sell their iPhone back to us and we'll give you like $50 for it. Well, not anymore. From now on, you take your used iPhone and you bring it to Apple and Apple is going to give you $1,000 for your used iPhone. All of a sudden, the entire internet, no person on the whole internet would sell an iPhone, not on eBay, not on Craigslist, on anything. No one would sell their iPhone for less than $1,000 unless it was like just slightly less. Maybe you get one for 900 here or there, just because it's convenient. Hey, meet me at work and you can pick up my old iPhone for 900 bucks or, whatever. If you buy a bunch of them, you can get them for. No, everybody would just take their iPhone and then they would sell it to Apple and get the full 1,000. Simple, it's easy, and that's how they put a floor under the price of an iPhone. You don't put a floor under something by offering to buy it at lower than the existing price. Hopefully those examples are enough to straighten this out. And, probably most of you guys are group members, so you already get it because we've discussed this. But the entire internet is literally wrong about this. I have not heard one person or seen one person write a paper or explain this correctly. And it's pretty obvious, anybody that understands like market dynamics, supply and demand, and what Russia's doing here. And if you don't believe me, you look at the chart of the ruble and look at, has it strengthened since Russia came out and quote unquote pegged the ruble to gold and has it weakened? Well, there you have it, done. All right, so anyway, there's my tangent for today. Hopefully you guys enjoyed it and, got something out of that. But it's very, very important to understand that people are just wrong about what they're, all this stuff they're spitting. And most of the people that are writing these articles are probably hugely invested in gold or trying to sell you gold. So they're like, oh, we'll just make this super complex and then we'll explain it to people. We'll make it sound easy. And then we'll be completely wrong, but they'll believe us because most people don't understand. So Bitcoin futures chart. Remember, guys, if you are just tuning in, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So Bitcoin futures obviously had been closed all weekend, opened back up, and just had a little bit more selling off here. We are below the 200 exponential. We're in a confirmed bear market. 200 simple is actually like rose back to the upside. So technically, like I said earlier, it's technically still bearish, but trying to break out of a bear market. But this is our typical reversion of the mean play. Doesn't look good. And then we're getting a little clearer of a picture on the Bitcoin spot market. As the Bitcoin spot market, we basically came all the way up to the 200 simple, got rejected exactly at the 200 simple, which of course, not to like call tops or anything, but I did unload my Bitcoin position at the 200 simple. So congratulations to me. We did it. We bought the bottom and we sold the top. Congratulations. And to all the group members that were able to capitalize on Bitcoin, Ethereum, or any of the other shitcoin trades, congratulations as well. But that being said, basically I've topped out at 200 simple, pushing back down to the downside now. We have lost the 200 exponential now on the daily, and at this point in time, confirmed back into a bear market. Looks terrible. Looks absolutely terrible to me. Now we're in the bearish control zone. We have had a very aggressive, downside move here. So there is potential we could print some bullish divergence and have another push back up. But the truth is, we got rejected pretty hard off the 200 exponential and simple. So I have a hard time trying to get bullish here. We have also lost the slope line, the TJD, TDMACD. It has flipped over red. Looks really bad at this point in time. The 821 has crossed the downside. That's bearish. We're below 200 exponential and simple. That's bearish. We're in the bearish control zone and Stochs are angled to the downside. That's bearish. And then we're below the zero line. We have all red histograms. And then we have a red slope line. Literally everything on the chart is bearish right now. So of all the different bits and pieces of the indicators, we talked about them as we were starting to go up, as we were flipping this, as we were getting above the zero line, as we were crossing up. We talked about the various bullish indicators. as it was starting to flip and look more bullish. Well, every single one of them is bearish now. It looks absolutely terrible. And then on the weekly, so we basically had bearish divergence between our tops right here. We had bullish divergence between our bottoms right here, and then the bullish divergence has pushed up. We talked about this exact scenario. It looked like and again, not to call anybody out or whatever, but we had a couple of group members talking about how bullish this looked. We were about to get the cross back up, and then last time we got the cross up, we went to new all-time highs. Well, look what happened. We came back down, retested it, and then we immediately, sold back off, and we're below the 8 now. So now we're back below the 8 and 21. This looks very clearly like a rejection. And what happens after a rejection? Well, it usually sees continuation to the downside. So this was our basically, we've been talking about this forever. It's not like a big surprise, but, we basically had, depending on how you want to look at this, I don't even know what I have drawn on this chart anymore. Oh my God. Looks like someone puked on my chart. Yeah, okay, I'm going to just turn that back off. I mean, we hit our key levels and everything, but it basically looks like we had either like a 1, 2, 3, 4, 5 down, and then a 1, 2, 3 up, or, an A, B, and then we're expecting a C. I mean, there's a lot of different ways you could look at it or break it down, but at this point in time, it looks very likely that we're going to see continuation of the downside. This was exactly the opposite of what you want to see. Any just consolidation above those levels would have looked pretty good. But a breakback down below them is going to look pretty bad. And I think it's very likely the way futures and, the stock market closed, just in general, the way things look, looks very bad. And then obviously, we've been talking about this. It's been 4 months now. We've been saying the same thing for 4 months. We closed here below the 8. The target was the 21. And then the target was back to the 8. And then the target was back to the 21. And the target was back to the 8. And now the target, once again, back to the 21. So I fully expect us to be at 38,164. So at this point in time, we are literally just chopping around between the 8 and 21. And we know what happened, back here. This was 2017 blow off top. We chopped around between the 8 and the 21. Everybody got bullish, eventually said, we're going up. It's going to go up. It can't go lower. There's a floor. It'll never go below 6,000. This is it. It's the bottom. We're buying in. And then it lost 50% in, 1 month and a half. Didn't quite see the same reaction like where we were stuck in between the 8 and 21 in the previous, bear market top. But, essentially that's what we're looking at. So we kind of saw a little same thing back in here. We kind of bounced the 8 and 21. And then we had that capitulation, the black swan event that our indicators perfectly called out. But we still have, even though on the weekly chart, we have bullish and bearish divergence playing out, on the monthly chart, we literally have a peak right here and a peak right here, a peak right here. And then we have a higher peak right here. We have a lower peak right here and a lower peak right here. So when we look at this, that's our peak. That's our much, much lower peak. And then it rolled back over. This is our peak. And then that's our 70,000 peak, much lower peak. And then it rolled back over. So, I mean, at this point in time, this looks to me like monthly. I mean, it is. It's 100% monthly bearish divergence. So when you see monthly bearish divergence on something and then it finally breaks in that direction, we're talking about, capitulation breaks. We're talking about wreck city. And to tell you the truth, because of, Michael Saylor and his like $1 billion purchases and everything, I think it's realistic to say that probably our 6,000 from back here is probably 30,000. Because that's basically the area where Michael Saylor, has essentially, quote unquote, put in a floor on Bitcoin. Even though he never buys at the bottom, he always buys at like ridiculous, horrible places. But assuming that that's his average price, I would imagine that he'd be very strongly defending that, and so would anyone else that's around that same average price. So I think that 30% move, assuming we got something that $30,000 price point, assuming we got something similar to this move right here, we lost 6,000, and went to 3,000. So maybe we lose 30,000 and go to 15,000. I don't know. We'll have to wait and see, but it doesn't look good. The Bitcoin long-term chart does not look good. The Bitcoin weekly chart now does not look good. And again, I was warning people about this. I'm like, better be careful here because it's not looking good. And it just looks like a bearish reset. Look like that bullish divergence playing out into a bearish reset. And now our daily chart doesn't look good. We have lost key levels. And then if we actually go down, again, I don't like going to the shorter time frames on stream, but, this was a perfect, we flipped into a bull market here on the 4-hour, again, took positions on Bitcoin, rode it up to the top, sold into the 200 moving average, And then we've been a downtrend ever since, putting in high, low, lower, low, you know, continually just lower highs. And now here we came back up, got rejected to 200 exponential. See a capitulation candle coming in right here. And now the 200 simple is about to roll back over too. So we're confirming back into a bear market once again on the 4 hour. So, you know, people ask, oh, do they work on shorter time frames? They 100% do. I watch the 15-minute, I watch the 1 hour, I watch the 4 hour, I watch the daily, the weekly, the monthly, and depending on what my time frame is for a trade and what, you know, I'm looking at, you know, I trade with the trend. So if we're in a monthly, or I'm sorry, if we're in a daily downtrend, confirmed, you know, bearish trend, bear market, any trades I'm taking on shorter time frames are going to be in accordance with that. So any bullish trades I'm taking are against the trend. So it's just a scalp. I want to get in and out as fast as I can and lock in profits. And the same thing like on different time frames. You know, if we're in a bearish 4 hour and a bearish daily, you know, I want to be in like shorter time frames on the 1 hour, you know, and get in and out of those trades. So here you see we confirmed into a bear trend on the 1 hour at like 46,000. And since then we're down 10%. So if you were looking at the 1 hour, oh, look, it worked perfectly. Boom. You know, if you did the same thing back here and we confirmed into a bull market right here on the 1 hour, you got in at 39,000, you know, and then obviously we came back down. You technically got back out at 46,000. So, I mean, it's the easiest, most effective indicator I've ever seen. I mean, that's literally why I made it, because it uses my strategy and it just turns it into an indicator that a child could use. I do want to talk about one more thing, actually. So what I'm going to do is I'm going to delete this chart right here. And then I want to actually pull something up that I haven't like looked at on here or showed on here before. But it's been working particularly well. Sorry. Hopefully I didn't just do that in the mic. Okay, so we want to go to the sorry, wrong one. I can't remember if it's the shift. I think I was doing it on the 4 hour and it looked pretty freaking good. All right, there we go. All right, so that's pretty well lined up. And then I just want to get in here and kind of turn a couple of these off. Just going to leave on the I think I have the 7.5 on as well. All right, I want to let me. Oh, I hate TradingView updates. Let's mess with this one. What is it doing? What? Oh my gosh. Okay. So I'm pretty sure those are the only ones I had turned on mine and it worked like perfectly. Okay, so I basically just set, I should have left it up and said that out loud while I was looking at it. So I basically just turned on the regular pitchfork and then I put it on 0.5, 0.75, and then 1. Okay, so if you wanted to do this yourself, you could also. So essentially what we did is we took the bottom, which was on January 24th, and that was at 33,000. And then we had that pretty strong run up right here on February 10th at 46,000 roughly. And then we had our next swing low, which was on February 23rd at 34,200. So if you wanted to replicate this, you could with those. And you can obviously listen back to it, or anybody in the group I can show you or whatever either. But essentially, what we have is once we draw that in place, we see that the actual like heart line of the channel extended out, hits these two peaks right here perfectly. And then we see a bunch of confluence throughout the range. And we're basically back down at that level right now. And then we see obviously our top line acted as resistance when we got back up to it. And then we see we have the bottom line, extended out through here. And then obviously we see this is our 75 level on the top and the bottom. The way this works is it's like the 0 line here, and then that's like the 50 and the 75. So the 75 acted as peaks right here multiple times and then support through this range. And then on the bottom side, the 50 acted as support 4 times basically. So this thing is showing up pretty clear. Now you can turn on other ones. You can put on like the 25 and stuff like that if you want. You can use fib numbers instead of like just regular numbers. You can do whatever you want with it basically. I don't like to like doctor it and make it look exactly like what I want it to do. But like when we turn on the 25, we see like that was clear support right here. It was obviously acting as resistance here. It was acting as support right here. And then we just haven't come back down to that level yet. So 25, not nearly as important. You could, if you looked at fib numbers, maybe it would show up just as good. The 382, the 618, the 786, the 236. A lot of those are going to basically line up with 75 and, obviously like 25, etc. So maybe you would see some confluence between them that way. I didn't really mess with it that way. I guess we could just put one up there and see what it looked like if we just used fib numbers. Of course, it like has to like save the most recent thing that I did. I'm not even gonna mess with it. It's too annoying. All right. But anyway, so you see what I'm talking about here. There's some clear resistance and support levels, interacting with our pitchfork right here. So it's worth note. I've had it on my other chart and it's been playing out like beautifully. So, that basically gave us this target to the upside as basically the peak. And then when we look at that on like the daily time frame, I mean, it literally lines up like absolutely beautifully with the 200 simple moving average. So, and then, we've seen some other pretty clear interactions as well. This was the 200 exponential lining up pretty much with that 75 level. And then now here we are at the heart line. So it does look like we would find some kind of support around this level. And then obviously we have a couple step downs if we want to pay attention to them as well. So I thought it was worth note that I would like share it with you guys. Just another tool in the tool belt. I don't really use like pitchforks or shift pitchforks like all that often, but sometimes they can be pretty useful. So I think it's worth taking a look at if you have never used that tool before or, interested in something like this. So that being said, I'm going to go ahead and just back all this back out and turn back to my old ugly chart. And I'll probably do another updated video where I just draw like the chart from scratch again. Oh no, it won't let me back out any further. Oh, okay, there we go. Oh, we lost it. Okay, so yeah, that being said, we have pretty much hit our targets to the upside now. So we'll see what happens. We have these triangles and the support right here, the ascending support. So we'll see how that goes. We talked about the 2, if that was going to be the top. We obviously expected it to go a little higher to our red box. And then the potential high that we expected was the 618. So it's still possible we make it up to the 618 and then we peak out there. And that is our like 2 of the 5. It's possible this is the 2 of the 5 already. Obviously we know now it's not that one for sure. But you guys know like macro, what I'm looking at here is essentially this macro A, B, C pattern. And this is our 1, that's our 2. And then we're potentially starting the 3 now. And then the 3 would potentially take us back down here to like that 24,000 range. The 4 bounce back up, retest this level, and then the 5 goes much lower. So still looking at that macro. Everything still looks the same, playing out beautifully. I mean, Bitcoin and stocks have been trading very, very technically, and we've definitely been ahead of this game the whole way. So that being said, that's enough crypto and Bitcoin. Obviously bearish. Ethereum still slightly more bullish above the 200 exponential. Got rejected on 200 simple. As long as it holds this level, it looks okay. It's on top of support, but I don't expect all these like shit coins, including Ethereum, to just start pumping while Bitcoin melts down. Do not expect that to happen. Weekly crypto market cap. So we talked about this 2 trillion level and how important it was. And then, of course, we closed back at or below it, 1.9 trillion. So again, failed to cross the 821 back to the upside. So all the people that were getting overly bullish right here, well, you just got smacked in the face by crypto. No surprise. And then Bitcoin dominance chart. It did break down below the 821 cross and started to move back to the upside. Again, we're basically at the heart line of our little like descending channel. We have triple bullish divergence. I do expect this to gain. I expect Bitcoin to gain value. Clearly in an uptrend, multiple drives of bullish divergence. We see the blue stochastic rolling back down. I do expect it to bounce and then continue to the upside and enter the bullish control zone. Now, what's that going to look like? Well, probably when we get back up here eventually, measure, move, break, and then potentially a retest of a 200 exponential and simple. We see already the 200 simple is flattening out. So we'll see what happens. Taking a look at Matic next. Getting rejected off 200 simple and exponential. Retesting the lows. Looks bad. Looks like it's going much lower. BNB holding up okay. Not as strong as Ethereum, but looking weak. So, I mean, if it holds this level, it looks okay, but more likely than not, probably coming back down here to revisit the lows for BNB. So Avalanche, we're obviously a little more restricted on our moving averages. The 821 crossed the downside. We lost this support line, but we also lost it before. So arguably we didn't have it in the right spot. Maybe it should be right here. I'm going to leave it there for now because we had so much clear interaction with it. But I don't think it's unrealistic to look at something like this also as like a potential support line. So, I think maybe adding that one to the chart and then looking for potential support if it gets down to that level is reasonable. So, but obviously the fibs are playing out very, very nicely. I mean, it came all the way back down, almost did a 100% retrace, of that move up right here. It was basically like in between the 886 and the full retrace. And then it came all the way back to the 382, came back down, bounced to 786, came all the way back up, bounced to 382. We see very clear interaction with these fibs. So expect support temporarily at the 618 and the ascending yellow line. But if we break down from that, another retest at 786, I mean, this thing's just going to start looking worse and worse. It is very, 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 very low right now. And, this is real low. This is lower or less low. And here's our low now, and there's our low now. So when we do sort of pivot right here, there's a possibility we pivot with bullish divergence off of like one of these key supports. So there could be a nice bounce. I mean, let's assume we get back down to like this yellow line here, and then it bounces and retests to 0.5. That's like a 17% scalp. So there's definitely some plays there. Again, we talked about this last stream. That's why it's so important that we wait for that close above the 382 before we jump into this trade, or else, you would have literally bought the top. So well played. Hopefully I did a good job explaining that. Obviously, I explained it in advance and why that was so important, but it's good to reiterate that as well. Solana, rejected off 200 exponential and simple, completely in a bear market. It just looks terrible. Closing below the 8 and 21. Looks ready to melt down. Cardano. So we're at that key level. If this thing wants to put in an inverted head and shoulders, this is where we would take an entry. I don't like it. I don't think it's good. I'm not taking this trade, but there is an argument for it. If all of a sudden things start to flip around bullish and we see like a wick to the downside, rejection of lower prices, that might give you that move to the upside, and then that's when potentially I would enter this trade. But I don't like it. There's a possibility it plays out, but it doesn't look good to me. Cardano looks like trash. XRP, again, very much in a bear market, just continuing to melt down. I fully expect this to come back down and like revisit these lows down here, probably even come down and revisit the low since the high, which is a lower high on the macro, which is why XRP is garbage. We talked about Monero on the last stream. That was obviously brought up by one of the group members. Nice little bullish push up here. I know he did a nice little scalp off that. So again, looks good short term in comparison to everything else. This is definitely one of the stronger cryptos. It was able to reclaim the 200 exponential and simple, and it's actually moving to the upside. So we put a couple of descending like channels in play. So we had a couple different ways that you could be drawing this for a potential like cup and handle to play out. It did technically break above that second channel, consolidated at it. So as long as this holds, this actually probably looks good for the rest of that bullish move up. Now I wouldn't get too greedy with the full measured move, I would look at this as steps. So I would look at that 260 target as the first target, then the 618 as a 309 target, and then eventually, the completion around like 375. But again, there's no reason we can't do this again and just roll back over. So don't want to get overly bullish right now on Monero. Also, really do not like these privacy coins long term, just because of the legal regulations, government, crackdown, etc. But it looks okay for now. I think it's probably topping out right here, at least short term, but we'll see what happens with the rest of crypto. This thing has been rallying much stronger than the rest of crypto is. So maybe it's just overdue. Maybe there's, some kind of crazy news that I don't know about because I really don't care. But in all reality, probably that move has already played out. So, but it is on top of the 200 exponential and simple. As long as this area holds, it still looks bullish above like 208. So I'm going to go ahead and wrap it up there. Oh, you know what? No, we're going to do uranium stock deep dive as well. I forgot about that. So let's take a quick break, and then we will finish up with the uranium stocks and, gold, silver, and a couple other commodities as well. I got to clear my throat and grab a drink. All right. Oh, man. Take a little break. Wet my whistle. Jam a little food into my mouth. Now we can look at some commodities. And if you are just tuning in, remember it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So gold, not a lot has changed on gold. We had that bullish close back above the 821, so we did cross that back to the upside. So it does look okay for now. Main thing we're just looking at is for this to print a lower, excuse me, if this prints a lower high. If it takes out that 1958 level, it's going to look much better and probably revisits the highs. If it doesn't and it starts to roll back over, especially if it loses this 1935 level, it's going to look pretty bad. We have a pretty clear support at like 1920. So that's the real area to watch if we do see a breakdown. If it breaks and closes a daily below that, it's going to start looking pretty bad. So as far as I'm concerned right now, does this look bullish or bearish? Well, let me put it this way. I don't like seeing this right here. This almost always results in a bearish breakdown. Whenever the slope flips back over blue and we're below it, it almost always leads to rejection. Now, the real question is, do we get all the way back up to it and get rejected at it? Do we come back up and roll over before then? I don't know. But typically, more often than not, when you see that happen, it leads to a rejection. So I don't like that. As far as the stochastics are concerned, we see the knife stabbing up here. We see these pretty aggressively angled to the upside. But what do we see happening on price action? Well, this was our cross right here. So as the stochastics cross to the upside, the moving averages cross to the downside. We've pushed all the way back up from, essentially our low was at 21 on the blue stochastic right here. So from that 21 level, we have pushed all the way back up to like 56, and we've done nothing. We've just gone sideways. So again, we got to be real careful that this doesn't end up looking like a bearish reset. And what would lead to that? Well, basically, if we see these stochastics continue moving to the upside, we see the histogram keep moving to the upside, and then price action is not breaking out, moving to the upside, it's probably going to end up being a bearish, reset. And essentially, the indicator oscillators are moving back to upside before we break back down lower and lose this level. Because essentially what happened is we sold off pretty aggressively, and then, we basically put in a temporary floor, and then the indicator oscillators had already come all the way down to the bearish control zone. And then we basically stopped at the bearish control zone, stopped at this clear support right here, and then just been going sideways since then on price action, but the indicator oscillators are going back to the upside. So that tells us there's some potential here for price action to diverge from the indicator oscillators, and then essentially they're moving up while price is just going sideways. So right now it looks okay. There's definitely still potential for this to break out to the upside, but we have to be very careful because this is exactly how I would trap people, in a position before that breakdown. Because a lot of people are buying into this saying, okay, there's a floor under gold now. Gold won't go down. Look how many candles have closed at the floor. That's beautiful. But we know realistically this is a bearish pattern. We have a high, a low, a lower high, that same low again, and then potentially another lower high, and then that same low again. And what is that? Well, it's a descending triangle. And we know what happens with a descending triangle. Eventually we get the breakdown of the descending triangle over 66% of the time. So, and that's the heart line of our descending channel right here. Now, this is starting to look even more and more, like we had basically just drew it correctly right off the bat. So we only have one touch on the bottom and like that one blow off top touch right here. But the heart line acted as support through here, acted as resistance 3 times, acted as resistance again like 2 times. So if we now get a breakdown from the bottom of the descending triangle, I would expect us to come down to the next key fib level, which also would line up with the bottom of the channel, somewhere around like 1864. So that would be my target short term if gold breaks down. But if it breaks to the upside, then I was wrong about everything. Russia put a floor under gold at 1500 and now it's going to the moon. But probably not. So silver, as long as silver is above the 200 exponential and simple, it's okay, but it doesn't look good right here. Gold is so much more bullish than silver is on the daily chart, but it does look okay. And then the weekly close was okay. It was back at the 821. It's holding some key levels right now, but we do not want to see this get any weaker. I mean, it came really close to the 200 exponential, so we don't want to see it revisit those lows. And then the gold silver chart. So we've been talking about this quite a bit. and how this could go either way. We averted the cross to the downside, came all the way back to the 200 exponential, closed at the 200 exponential. So now the real question is, are we going to get this? I mean, it looks like this is just going to keep getting, just kind of inching its way up, getting pushed up, and retest the 200 simple, which is all the way back at 82 to 1, silvers to gold. If we come up to that level again, we probably are going to end up breaking through it. We probably come up to it, chop around for a little bit, and then go up, and then eventually, my target's up here at like 90, 92, somewhere around like the 0.5 retracement, the measure move breakout of the descending wedge. I've talked about this a million times. We don't need to go into like detail with it again. I want to spend a little more time on uranium. So XPD, palladium, broke back above the 200 exponential on simple. It's trying to save this level for now. So we'll see what happens. As long as it's on top of the 200 exponential on simple, it looks okay. Oh, that's right. I did put out like the wrong. What did I put it up in? Oh, US dollar per kilo. So yeah, don't worry about the actual numbers. And then XPT, platinum looks very bad, below the 200 exponential on simple, confirming the downside. We looked at this, did a pretty deep dive. We do have a buy, sell, buy divergence signal. So I wonder if this thing is actually going to bottom right here. I doubt it. I think probably what's going to happen is we're going to get something like this, where we see a buy, a sell, buy, and then another sell. And then, it ends up just melting down much lower. I would not get overly excited about this. Platinum just has looked like trash for so long. I expect it to continue looking like trash. All right, so we talked about the pot stocks and how and why it was so important to take profits on these things. I mean, look at them now. They're back at like the entry prices right here. So if you didn't take profits along the way, you were up like 25 and in many cases, 50%. And now they're right back where they started, probably going lower. If we see some divergence and they put in higher lows, I'll start to get bullish on these things. Obviously, we had, we had some bullish news for pot stocks. There's like a federal bill to decriminalize marijuana. We saw earnings from Tilray that were basically like okay. It was like a beat on, what was it? It was a miss on revenue, but a beat on earnings. Yeah, I mean, but nothing crazy. So yeah, and again, same thing. Hexo just back down here at the lows again. Again, we know these are the worst performing sector for the last multiple years, while everything else went parabolic. So when they do bottom, it's going to be great. But we want to take our sweet ass time, because they might, if the rest of the market melts down, they could melt down right there with it. And they're already real low. They could go even lower. They could go all the way to the zero, to the no-go, to the bankruptcy-o. Okay, so into our uranium stocks. Okay, so CCJ is usually the one I take a look at, but I'm also going to look at URA, UEC, U, and then, or U cubed, and then UROY. So we got a royalty company in there, a couple of like smaller cap, like uranium miners / producers, and then we have like, obviously like CCJ is one of the larger players in the space. So let's zoom out to our longer time frames, and we will do a nice little breakdown. So we obviously had our peak way back here on starting with Cameco CCJ at 56, and then we have, as of now, our low down here at $5. So lost over 90% of its value from June of 2007 to March of 2020. So 13 years of just getting absolutely wrecked. At which point in time, basically put in its bottom, and then when we look back at the chart, we can see clear interactions at the 382. We see clear interactions at the 886, at the 786, at the 0.5. I mean, you get it. We see clear interactions the entire way. So very safe to assume, for now at least, that we have put in a macro high and we put in a macro low. So that being said, now, where are we going next? Well, the key areas to look out for, taking out this high. Obviously got very bullish back here at our cross. In blue, which if we go to a shorter time frame, that will make more sense. That was when the indicators were flipping over bullish. But at this point in time, turning off the drawing tools, we're now above the 200 exponential and it's sloped to the upside. We're above the 200 simple and it's sloped to the upside. And, essentially, this is bullish as it gets on a monthly. So the only thing left to happen right here, I shouldn't say as it gets, the only thing left to happen is the 200 exponential to catch up and be on top of the 200 simple. That's as bullish as it gets. Everything else, extremely, extremely bullish on this. So we know some key levels we're looking out for is obviously our target, which is the 786. That's my first target to the upside. Once we hit that, I do expect a retracement at some point in time, probably back to the 618, which we would expect to hold this support. That's going to be a retest of the 200 simple also, which we already retested. So we don't want to get greedy on these pullbacks trying to buy back in. But I do fully expect some kind of pullback here. And then when we get into that. But the real level we're paying attention to is 886. 786 can act as resistance and then a peak and then just go lower. The 886 almost never does. It will act as resistance, but it almost never acts as like a macro top. You almost always see it either top of the 786 or double top. Realistically, though, you guys know I'm extremely, extremely bullish on uranium and nuclear power into the future. So I fully expect this to be putting in new highs. So, you know, if there was one thing you told me, hey, you got to buy this and you can't sell it for, 10 or 20 years or whatever, what would it be? You guys know it. It's uranium. I would fully be invested in uranium for the long term because it takes 10 years to build a nuclear power plant, and there's a record number of nuclear power plants currently being produced, built, manufactured, whatever you want to call it. So right now, there's all of a sudden a ton of nuclear power plants in excess of 150 being built, which is exponentially more than has ever been built at a single time in history throughout, the past, especially the recent past. So if we know they're on average taking, roughly 10 years to build, sometime in the next, 2 to 10 years, we're going to see a bunch of these things start coming online, and then we're going to start seeing demand for uranium go through the roof. All of a sudden, the EU is classifying, uranium nuclear power as green energy suddenly. So it was the devil forever, and now all of a sudden it's good. Now all of a sudden it's part of that green agenda, and arguably is one of the few things that could actually help us get to, that quote unquote green agenda. So I only see bullishness in the future of uranium. We're going through a macro like energy crisis around the world for like coal, nat gas, oil/gasoline. I mean, what can fill the gap? What's literally like the best thing? And the only reason we haven't been producing more of it for the last like 20 years is the price of it is too low for it to be worth it, but there's tons of it and it's extremely efficient and has super low waste. You got it. Nuclear power, baby. So very bullish on uranium. Fully expect this to be back at its new highs in the next couple of years. So, and you're like, yeah, but it was $30 and then it's going to go to 60 in a couple of years. That's only 100%. Well, it's a smooth, cool, juicy 100%. And if we get added to a position around like 22, that's really from, 22 to 60. And then I really do expect it to go higher. So yeah, that being said, very, very bullish on uranium, and the CCJ chart looks pretty damn good, obviously. And then if we go down to a weekly, obviously have been finding some support along the way. We're very close to our target. We're close to putting in potential bearish divergence. This really needs to creep up higher than that previous peak, or we're going to print bearish divergence between these two peaks. So essentially, it's already higher on price action. So this has to run anywhere. It doesn't matter where it goes to, but this has to run. So it's actually better if this just kind of slowly grinds up to the upside and lets the indicator oscillators like catch up, so it doesn't print bearish divergence. We are basically at that level now. So as long as this continues to the upside for a couple more days, couple more weeks, it's going to look okay. If it starts topping out right here, it's going to be printing bearish divergence, and it's not going to look good. It's also at a key fib level, so not a good place to enter in my opinion, but long term, very, very bullish looking. So, and then again on the daily, I mean, just looks fantastic. But again, you got to be careful of that bearish divergence. So, and most of these charts are going to look the same. Some of them look just slightly different. This one is URA. Nice. Okay, so URA, we have basically from the peak back here in 2011, and we have our low back here in 2020, that Rona dump, and it was from $131 all the way down to $6.90. We'll call it 7. And then we put in basically a 1, a 2 retracement, a 3, a 4 retracement, and then a 5, and then started to retrace down here. So again, what I'm looking for to happen here, now on the monthly, we're technically higher than we've been. So if we close here higher than this, then it's probably going to look more like this was a 1, that was a 2, and that this is all part of the 3, and then that was 4, and then we're going to put in a 5th wave. but we don't know that yet. Obviously, if we close up here, it's going to be a higher high. Also, that could be 5 waves, and then we're putting in an A, a B, and then we come down lower on a C, which is also a possibility because we know in certain circumstances, such as Bitcoin, sometimes we can have that B come up higher than the top of the 5. So those are the two scenarios that I am looking at right now on URA. Obviously, unfortunately, we did not get quite down to our reload position right here. So I was planning on really loading up the boat on a retracement. Hopefully we do end up getting back down there, but don't want to let this run away. But also, you know, when I'm trading in and out of uranium, I'm never selling my entire position, obviously, because I'm just macro, very bullish on it. So now my real bull case on this is that essentially that was our potential top at the 0.5. You know, where we pushed up to basically was at the 0.5. So say that was our top and we come up, put in a lower high, and then we do go lower. That retracement right there, I'm looking at a 50% retracement or potentially a 38.2% retracement from the bottom to the top of what could be the 5. And then that being wave 1. And then wave 2 being the retracement between the 382 and the 0.5 here. And then again, a pushback to the upside. And then that being our wave 3, taking us back at least to the 618, if not maybe to the 786. You know, and then again, coming back down, retesting the top of the 0.1, or I'm sorry, the top of the 1 with the bottom of the 4, and then potentially back to all-time highs. So again, $27 right now, and we know the all-time high on this was $131. So there's a lot of juice on this one. I mean, it's basically like a 5x. Just from where we're at right now, back to the previous all-time high, it's 400% gains. So not a bad day. I mean, probably takes a while. Probably not a bad decade for uranium. Technically did hit the hard sell right here and break down on the monthly. So, you know, this, I mean, it's a very bullish macro environment right now, but this does look super technical. Like if this really puts in a lower high right here and then rolls over, it's going to basically look perfect. Now, does it have to do that? No, it could easily just see that continuation, and then that's the top of our 1, and then, you know, our 2 would end up being like somewhere around more like here, and then really like this is our 5. Oh. Yeah, you guys know. I've just explained it, so you get it. Maybe this was all part of the 3, and then that was a 4, and then here comes our 5. So we'll have to wait and see, but, you know, again, very bullish on this long term. But really does look like it's getting ready to or has topped out. So this one did not put in a new high here as where Cameco did, CCJ. Also at a key area where we typically see rejection on the weekly. Did flip into a bull market here on the weekly not that long ago. Hard buy signal. 821 crossing back to the upside. Got to look out for a double top on this one. And then still very bullish. The 200 simple is above the 200 exponential. But if it stays up here long enough, it'll cross back to the upside. So, but we'll see what happens. We shall see. But yeah, I mean, obviously very bullish on all of these. Next is UEC. And there's probably other like good, great, grand uranium stocks as well. These are just a couple of the ones that I participate in. Uranium Energy Corp. So we basically have hit our 5 target at this point in time. So, you know, we had this as basically like a sloppy 1, a 2 retracement, a 3, you know, a pretty close 4 to the 50% retracement from the bottom here to the top there. And then saw the continuation give us our 5. Obviously got it much quicker than we were expecting. So, you know, assuming this is the top right here, we're putting in sort of like a double top, you know, basically some potential. I mean, it's not really divergence. It's basically like even. I mean, I guess technically it is divergence. But on these last couple pushes, we're putting in like some real small, some little itty bitty divergences. Like here we have a high. Technically that one is lower, so there's no divergence between those 2 points, but there's potential for some divergence between this point and this point, or this point and this point. So again, got to look out here. Want to make sure this isn't putting in like that wave 5 top. If it is, though, that's actually better for us because we'll get an opportunity to load back up our position. So when we kind of zoom out here, once again, I think I have the fib from the bottom to the top, don't I? Yeah, so that would be a fib from the bottom to the top. So assuming that it topped out, it basically came down to the 236, came back up, and potentially like double top. If it comes down again, we're looking to reload around like the 382 at like $1.99. So that's the area I'd be looking for. But again, you don't want to get too greedy on these uranium stocks because they really could run. And when they do, it's probably going to be for a long, long time. So yeah, that is UEC. Again, very bullish. And then U. Same thing from the top to the bottom. From this one goes back to 2007, all the way to our bottom right here. Had some trouble getting above that 236. We did burst through it. Saw some resistance at the 382. Now it looks like we're headed up to the 0.5. So from that entry point, I mean, what was that? Almost 400%. Man, anybody else that took this trade with me is probably loving life right now. Yeah, I mean, we're the better part of the way there too. That's probably where it tops out temporarily. This one is not super clean. I mean, but we can probably get some kind of other like fib going on, like similar. Something like this. Probably looks better on a shorter time frame, but probably something like that. And that would be like our 5. And then again, what we're really looking to happen on these things is we're looking for that to end up being like a 1. And then we're looking for basically like a 2 retest, and then basically a 3, and then something like a 4, and then, back to at least all-time highs for a 5. Maybe even higher. These are rather, I mean, it sounds crazy when we're talking about like hundreds and thousands of percent moves, but, these are rather conservative targets. I mean, now granted, this topped out in 2007 and was in a downtrend for 13 years, but it topped out at $233 and it's now at $10. So, I mean, even though it's already come a long way and some people might be late to the party, I mean, just back to all-time highs, which it doesn't have to get there, but we have confirmed back into a monthly bull market for literally we had a little confirmation right here. We had a little confirmation back here, but this is the longest one we've had in that 13-year period. That's a 2,300% move. So, if you're looking for that long shot, that retirement money, I mean, probably play the lottery. Or invest in weekly confirmed into the bull market back here at about $2.77. So again, it's already run a lot, sure, but it's got some serious potential. Now, if this comes back down on the weekly, we're looking for it to hold support at like the 200 exponential and simple. So maybe it doesn't go this deep. Maybe it gets like a shallow retrace on the 5. Typically, you see the 5 retrace the entire 5-wave structure. So a 5-wave retrace, assuming it gets up to there, we don't know what's really going to happen. A 382 bullish retrace would be back at like 475. So, you buy it right now and then it goes down 50% and you get scared and sell, you might miss out on a 23x. If you wait, it might run away on you. So, I mean, it's really up to people. I can't make people make up their minds. But, I mean, it's not like we weren't telling everybody how bullish we are on uranium back here. I mean, I got extremely, extremely bullish once we broke through this level. So, I mean, obviously, I literally didn't even draw these on this chart. All these have been on this chart for I don't even know when we drew these. We probably drew these like 6 months ago, guys. Anybody that has been watching for a while knows. And then Roy. So this one's a royalty corporation, like royalty company. So they basically just get royalties on, other companies. So part of the problem with commodities sometimes is as the price of the commodities goes up, it also, like, their production costs go up too, because labor costs are going up, fuel costs are going up for like diesel or for, whatever other key things they need to transport, refine and, dig out of the ground their energy, their uranium or whatever the commodity is. So with royalty companies, they make money based on the price of the underlying, but they don't suffer at all like the increase in prices from inflation on labor or like fuel or whatever. So they basically get all the upside with none of the bad side. So we've talked about a couple of royalty companies for like gold and silver before. And, I basically said how they're like a nice, good hedge or like alternative play in those markets. Excuse me. Man, let me take a drink. Hang on one sec. And it's the same case for uranium as well. So if you haven't looked into royalty companies previously, highly recommend taking a look at them because a lot of times, because they're just royalty companies, they negate some of the pressures from pricing, but gain all of the upside exposure to like the underlying asset increase in prices. So they can often outperform. But that being said, obviously very bullish on the daily, but not nearly as bullish as the other ones. We're not even close to the high like we saw on some of those other ones on the actual uranium companies. This one has a very limited timeline for us to look at. It's March, I mean, technically January 2020. So it's basically just been running the entire time. It's hard to judge if this is going to be like the macro high for right now, and we're going to retrace. So the best thing to do is just slap a fib up here and see. We don't see clear interaction at the 236. I mean, maybe a little bit, and then we go lower. Maybe it's a front run of the 382. So the real thing we want to pay attention to is, do we end up printing some bearish divergence here? Does this come up higher? Or does price go higher, but the indicator doesn't? And then, potentially see some bearish divergence playing out. And then that's where we'll look for an opportunity to reload. We see some pretty clear reactions on the way up at the 382. Basically just went parabolic, so we don't really see anything at the 618. There was a pullback and a wick exactly the 0.5. So I would say this is a pretty reliable top for now. So essentially, we'll look for a bullish retrace, the 382, and that's where we'll look to reload on this one. Obviously it could come down to the 0.5, but I mean, this is such a strong support on the way up. I think that's probably the best place for us to enter. We don't really have like the same kind of like measured moves or anything like that that we have with some of the other ones. So if we look from this peak right here to the low, it ran like 1.618 fib extension. So if this was to come back up here and put in a new high, we could maybe run like a 1.618 fib extension on this and get a rough idea, potentially for a target of like 991, which is still like a double up. So we see some potential up here. So you guys know I'm extremely, extremely bullish on uranium. If I didn't have a position in uranium at all right now, I would just slowly start building a position, with not a ton of regard for the overall price. Because and I say slowly because then if it goes down 50%, you're not going to be mad. You're going to be happy because you're buying more at lower prices. If it just starts going up and keeps going up, you don't miss the boat on it and then regret that you didn't buy in, and the next thing you know, it's gone up, 2,300%, and you never bought in because you missed your opportunity. So I would rather buy into a bullish uptrend on something that's very strong, that has extremely strong fundamentals. And to tell you the truth, if somebody tells you that there's 150, I don't know what a uranium or what a nuclear power plant costs roughly. Like, it's in the billions, a billion, a couple billion. And, we know for a fact there's over 150 of these being built right now. So 150 different people, governments, corporations have invested multiple billions of dollars in something that takes 10 years to build. So I would say that there's some strong tailwinds behind uranium because obviously if we get 150 more nuclear power plants come online, that's going to be a hell of a lot of demand for uranium that all of a sudden shows up. So I fully expect uranium to just keep melting up or keep going up and then eventually melt up. And just because it takes 10 years for these things to come online doesn't mean they're going to come online and then the bull run's over. It could last for 20, 30 years, and we could be talking about, the trade of our lifetimes for many of us. So again, don't want to get overly bullish right now at the time, but definitely looking to be building positions or, reloading on positions we took profits on. Probably should have already, honestly, but, I did make the mistake of getting a little greedy on some of my targets. And sometimes it runs away from you. It happens. It's not that big of a deal. But I think if we get the full test back down here, that's going to look like an opportunity to buy. But yeah, definitely very, very bullish on uranium going into the future. I like the clean energy, the solar, the wind, all that stuff. But the truth is, it's just not there. Nuclear power is, tried and true. All the stuff that people are worried about that happened, back in the day with, Fukushima and all these issues, it's just not the same case anymore. If you look into how technology has changed in that time, we used to use highly pressurized water, and that was basically the fail point in these nuclear reactors. And now they use saline solution, and they don't pressurize it at all. So it's the main failure point of the nuclear reactors has been eliminated. And then actually we were discussing this in a group a little while back. One of the members had brought up, the essentially design, manufacture, testing, and potential implementation of these mini nuclear reactors going into the future. And technology has come a long way, so I think it's probably pretty viable. I believe that was the Rolls-Royce one that we were specifically looking at, but there's a couple of companies that are basically working on that as we speak. So again, the implementation of mini nuclear reactors, how many of them are going to get built up? What's the cost on one of them going to be? And then, what is the overall consumption / demand going to be as well? Because, I just only see a future where we need more uranium, and they're pulling it out of the ground at break-even prices right now with long-term contracts in the future. This is probably the most bullish asset on planet Earth right now, as far as I'm concerned. So that being said, I think we're going to go ahead and wrap it up there. That is our deep dive on UROY, UEC, URA, and CCJ. But pretty much just looking at the uranium space as a whole. Sprott has a uranium fund. Unfortunately, I don't think it's available still in the United States. Hopefully at some point in time it is. Obviously if you're not familiar with Sprott, look into that one. I believe it's called what is it, SPUT? No. Sprott. Sprott's the name of the company. I think SPUT is the name of the fund, but it's something like that if it's not. So just look it up and you'll find it. But if you're outside the United States, you'll probably be able to invest in that. And they have basically been just swooping up mass amounts of uranium and just putting it under their pillow, and every night praying to the uranium fairy that the price goes up. So, and it has been the whole time. So, but that being said, I think we're going to wrap it up there. Hope you guys enjoyed the stream today. Appreciate each and every one of you tuning in for our Sunday market look ahead. It is 10:34 p.m. Eastern Standard Time on April 10th, 2022. And, obviously, like always, is not financial advice. I am not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Yeah, I think that's going to do it. So remember, crazy volatile times right now. Protect your principal. And then obviously in time, when the markets start to shift, we start to get a better idea as to what's taking place. We can deploy it a little more aggressively. But we are seeing some key levels being violated and some potential for markets to start reversing, and not in a good way. We are seeing the major indexes for the stock market basically at key levels to confirm into or back into a bear market. Same with Bitcoin and crypto as well. We're seeing only a few things strong. Obviously, bonds have been just melting down. So at this point in time, I think the best thing to do is just stick with the smart money. And at that point in time, we can look for these other opportunities in like gold miners, pot stocks, some of these other, undervalued sectors. Again, the uranium is probably my number one most bullish case and most bullish play into the future. So, obviously super bullish on those. We got some serious targets in mind with some massive percentage gain potential as well. So that's it for today. Going to go ahead and wrap it up there. Appreciate everybody tuning in. Appreciate all the group members. Make sure you check out our next live stream. I do stream every single Sunday and Wednesday, 8 p.m. till roughly 10 p.m. or 11 Eastern Standard Time. And then every single Friday, we do our weekly market wrap up and look at crypto going into the weekend, look at where stocks are closing and what developments have taken place throughout the week. And that is every single Friday from 11 a.m. till 1 p.m. Eastern Standard Time. And that is it for tonight. Thank you all for tuning in. Everybody have a good evening. And obviously, let me know if you have any questions or anything, comments down in the video section. And I will talk to all the group members throughout the week. I appreciate all the support, all the kind words, and such a great community. That being said, I am Crypto Trend Trader, and I'm out of here.